Hello, this is the video editor for this video. To give you a little bit of background, this video was recorded when Mark Hulbert gave his presentation at the AAII Silicon Valley chapter on Saturday, April 8th, 2017. Besides taking out some of the excess footage at the beginning and the ending of the video, we only have two edits of any significance. First, around the 20-minute mark, there was a problem with the projector in the theater. Mark was answering a question during that point in time, and so we allowed that answer to the question to be completed, and then we did some very slight editings to take out the time period where we were fixing the problem. It was about a minute or two. And then we just cut directly back to when Mark picked up his presentation. The second slight edit dealt with the intermission between session 1 and session 2. We simply, after Mark completed his first talk, we simply snapped out the 15 minutes we spent during the break and the associated discussions we had during that point in time, offline discussions. With that, other than those two edits, this is an accurate reproduction of what happened that day. I will make one final comment. Some of the audience members shouted out their questions to Mark before we could get a microphone to them. Now, Mark usually did a pretty good job of repeating the questions and or providing context of the question when he provided an answer. So with those notes, I invite you to sit back, relax, and enjoy the video. Thanks much. Bye.
Good morning. First test is, can everybody hear me in the entire audience, backside, everything? Good. We're set up and ready to go. Welcome to our April AAII meeting. My name's Lynn Gillette. I'm the president of the local chapter of the Silicon Valley chapter of AAII. Hope everybody has a nice morning. It's a little bit of rain, a little bit of sunshine when I drove in. So, does anybody have any comments about finding the location or the instructions that were in our announcements? The reason I ask is we're trying to improve those. Our program today, Mark Hulbert will be presenting a program talking about what he's learned over the last 3 or 4 decades of monitoring newsletters, and then he's going to talk about sentiment and contrarian investing. When I initially called Mark and asked him to speak, my request was we'd like a program about the issues that really matter in investing, not the fluff or the frills that are, in the end, almost meaningless to the actual performance of your portfolio. And Mark has done a good job of monitoring that and commenting on that for a long time. And I think you're going to hear today, from Mark's perspective, the things that really matter long-term. Not the really short-term end of it. Now, next month in May, we've got a program. We've got a representative of Value Line coming to talk here, and that should be quite interesting. I don't know how many of you use access through the local libraries to Value Line and a number of other Morningstar, a number of other services, but they're available, and so we'll have that. And then we've got also a program on the stock market almanac. Cycles. I don't know how many of you are familiar with that. I remember the older folks will remember Marty Zweig. It used to be if you took his newsletter, you got a free stock market almanac every year. So anyway, those are the two presenters we've got coming up in May. If you're not familiar with the facilities, there are restrooms out across the hall, I think to your right. And I think, let's see, let me move. There we go. Here's a picture of Mark. Just out of curiosity, how many of you are familiar with Mark and the work he's done over the decades? How many of you have taken his Financial Digest magazine? Number of you. Well, let's go ahead and get started. Mark, welcome. Thank you for coming, and we're looking forward to your presentation.
Well, thank you, Lynn, very much for that introduction. I'm overwhelmed by the show of hands of people who are familiar with what I've been doing with my life for the last, golly, now close to 40 years, and I hope to redeem your trust of spending a Saturday morning hearing me talk about what I think has been learned over that period of time. Thanks also again to Lynn for helping to organize this and everyone else in the chapter. I don't know whether it was quite a year ago that you first called me, but it was the better part of a year that Lynn called me, and there are a lot of logistics involved in making something like this happen. And it's really the reward for many years of work on my part to be able to share what I've learned with you. There are plenty of people in the world who labor in obscurity, and so it's really rewarding to be able to sit and talk with a group such as yourself, and especially AAII groups, which I find are far more studious and really aware of the statistics and the objective patterns involved, rather than, as Lynn mentioned in his introduction, the fluff, which of course occupies most of the blogosphere and the TV and the radio and so forth, and all the comments you'll see about where the market is going. So I'm going to try to rise above that and look at a 4-decade perspective, which is the perspective I have on investment newsletters, and see what we can do in terms of drawing some conclusions about that. What I started to do in 1980, so actually I'm 3 years shy of the 4 decades that I say, sort of perhaps a little bit bragging about how long I've been doing this when I say that I've been doing this for 4 decades, but it's the better part of 4 decades. What I've been doing is tracking the performance of investment advisors. So what I did on June 30th of 1980, which is when I started, is I set up model portfolios according to the advice contained in a number of investment newsletters that existed at that time. And I've been trading those portfolios ever since. I like to tell the world that I have the easiest job. I simply get to do what they tell me to do. I don't have to try to figure out what's working or not. I don't have to figure out which way the market is going. I simply get to do what they conclude the market is doing and what they should do about it to make money. So I've been trading those portfolios now for 37 years. As you can imagine, many of the newsletters that existed in 1980 no longer are offered, and there are many new ones that have come along the way. So I add and delete as I am forced to do. But in terms of overall coverage, there are over 1,000 different portfolios that I've been tracking since 1980, and I don't throw away any data. There's no survivorship bias. So I have an enormous database on what actually worked in real time, not after the fact, not reconstruction, but in real time. How have they done? And I say how have they done relative to as realistic a simulation as I know how to create on our computers. Basically, we get feeds from all the exchanges. We take splits, bid-ask spreads, commissions, anything you can think about. The only thing we don't take into account is taxes, and that's a big deal, but it's just we don't know really how to put in all the assumptions about the impact of taxes. So you'll have to adjust that for whatever situation you're in yourself in trying to translate these ratings into your own performance. But other than taxes, it's as realistic a simulation we know of how to create of what your performance would be if you acted on the advice contained in these investment newsletters. Another crucial detail in that regard is that we use the prices that prevail on when you could actually act on the advice, which is, I'm sure many of you are aware that a lot of newsletters, even those that are very honest in reporting the records, will claim that they were able to buy or sell a stock at the price that prevailed when they first thought about making the recommendation in their office, which invariably is a better price than what you or I would get upon receiving the newsletter and then having to compete with everyone else trying to act on the same advice. So that's another crucial detail, is we're using the prices that you or I could actually get in the real world. We don't have to worry so much about that now, but back in 1980, that meant subscribing anonymously at different zip codes around the country to these newsletters, because in fact, one newsletter claimed that he heard another newsletter editor say, of course, no one would ever say that they would do this themselves, that what they were doing is sending their newsletters to us in advance of sending it to all their other subscribers in order to try to get the bump that would come from having all their subscribers go into a stock or out. So basically, I don't know that I need to say anything more in that regard, but we're trying to create and have created what we think is as realistic a simulation of how much money you would have made or lost if you followed religiously over 1,000 different strategies at different times. Only about, believe it or not, only about 20 exist for that entire 40-year period, or 37-year period, 4-decade period. But along the way, as long as they've been offered, and we have those returns. So the outline of my presentation today, as you can see on the overhead, I want to talk first before the break, which I understand is around 10:15. I want to talk about the overall lessons that I think emerge from tracking these advisors over this 37-year period. Giving you a preview of coming attractions, the biggest lesson is that it's extremely difficult to beat the market. By the way, I'll tell you in advance, everything I say today you already know. So that's a crucial pedagogical detail. The reason to say it isn't that you don't already know it. It's because we already know it and then act in our lives as though it doesn't apply to you individually. So I'm basically here to tell you that the rules of the universe apply to you too. So if you want to think of sort of a sub-lesson about that, corollary of that overall lesson, it's like, yes, it applies to us too. And secondly, the lesson is there are rational ways of responding to lesson number one. I want to talk about what some of those lessons are. That should easily take us up to our break. And then after the break, I want to talk about another consequence of the fact that most people don't beat the market, and that's contrarian analysis. Because it turns out contrarian analysis is another implication of the fact that most advisors are wrong. And there are do's and don'ts when you come to trying to put contrarian analysis into practice. And I want to talk about some of those do's and don'ts as they've emerged from my work. So that's basically the outline of the morning. And in terms of, I'll have plenty of time for questions, but if you don't understand something or have a question, don't hesitate to raise your hand or just yell out your question. This is an intimate enough setting that we can have a give and take rather than have me talk just continuously. So, without further ado, so let's go on to, okay, I've already gone over this, but basically is a summary of what I've been doing for the last 37 years. Anyway, look there at the bottom of the overhead. The number of advisors who've beaten an index fund is so low that as a practical matter, you could conclude that it's not worth the effort to even try. So we're going to look at these statistics in greater detail. But if you were to have picked an advisor in 1980 at random, you would have almost certainly had less money now, if you've been following that advisor over the last 37 years, than you would have had you put your money in an index fund. And even among people who think, in fact, there was a fellow who I knew at the time who was on my advisory board. He was a division of market regulation over at the over at the SEC. I was at Washington, D.C. at the time, and he said, okay, well, I know most of these advisors are lunatic self-promoters, so we'll eliminate them. You can tell who the lunatic self-promoters, he said. In fact, you can't. And then look at only those who are responsible, and he put that in quotes. But basically, I think we have a feeling for that. If we were to look at a newsletter, you can see those that are more data-driven seem to be more responsible in terms of following the data. But it turns out that even among that subset, and I asked him to identify in advance in 1980 which advisors he thought that group would be, even there the overwhelming majority did not beat the index fund over the last 37 years. This is perhaps the most important statistic that you'll hear from me all day. So here, question is, does that have to do with the fees or the actual stocks? The answer is both. Believe it or not, and I have a slide for that here in a minute, it turns out that even without commissions, they would not have beaten the market, which is devastating, isn't it? It's like, we'll go into that in greater detail. But here are the numbers. So this is over the last 30 years. Look over there in so that bar there. If you look at the number of newsletters, and this is just a 30-year period, and the reason I picked 30 years is I got data from Lipper for the number of equity mutual funds that beat the Vanguard. So I wanted comparability with the Lipper data. So for the last 30 years, the number of newsletters that I was following 30 years ago that have beaten the market since then is around 1 out of 20, 5%. The number who lagged buy and hold over the last 30 years is around 10%. And the vast majority of them didn't even make it over that period of time. Now, as you can imagine, a newsletter that goes out of business usually goes out of business because it hasn't beaten the market. It doesn't usually go out of business because it's ahead. So you could probably combine both of those and say, this is the number who actually beat the market, and these are the people who did not end up helping you beat the market. Okay, how about mutual funds? According to Lipper, over the same period of time, the Vanguard Index 500 fund has outperformed 67% of all U.S. domestic equity mutual funds. What's interesting is that their database does have some survivorship bias in it. So that 67% is actually comparable to what I find for newsletters. And what I find interesting, and I put up there, is the survivorship problem among mutual funds. According to Standard & Poor's, over just the last 5 years, 38% of large cap funds and then all the way up to 45.5% of small cap funds didn't survive. And so anytime you do a sort on mutual funds at Morningstar or anywhere and say who did best over the last 5 years or a longer period of time, just extrapolate out 45% over a 5-year period, over a 30-year period, you can imagine most of the funds did not survive over that period of time. So you get a hugely biased picture of reality when you only focus on the survivors. That's what survivorship bias is all about. So this is just off on a tangent, but don't ever draw conclusions that are too optimistic because you're only focused on the survivors. So the lessons to learn, again, this is probably one of these important things that seems so obvious, why even say it, but I think most of us don't actually live our lives as though that we actually believe it. If you were to have picked an advisor at random, you would have had a 1 in 20 chance of bettering the market. 1 in 20. Isn't that amazing? And the corollary is that the average thing you do is a mistake. Now I want to talk about that corollary because it follows logically, but a lot of people are surprised when you try to draw that corollary. The idea is, but if you think about it, on average, everything we do is a mistake. Isn't that amazing? What other pursuit in life is there where on average, everything you do, including those who you think are the experts, on average is something that's to be regretted? And yet that's what investing is. And I want to talk a little bit more about that because I think that's overwhelming. The average thing we do is a mistake. So now I want to talk about this, and this gets back to your question about the commissions. This is a study that a UC Berkeley professor did a number of years ago. A number of you, I'm sure, have seen the study. It's based on 64,000 accounts at a discount brokerage firm over a number of years. And what he did there is he wanted to look to see why so many people end up lagging the market. And what he did is he looked at every time one of these investors sold a stock and then looked to see any other stock that was bought within 30 days of the sale. Now, of course, he couldn't interview all 64,000 investors to find out why they sold one stock and bought another, but he made the assumption, which seems entirely reasonable, that if you buy a stock within 30 days of selling another, you must think that the new stock as a replacement, the old is going to do better. If you didn't think the new one that you bought is going to do better than the one you sold, why would you have done it, right? Entirely straightforward assumption. He then created pairs, the sale and the subsequent purchase, and compared those two stocks, creating many, many pairs, and looked to see how the purchase stock did relative to the one that was sold. And guess what? Over the 4 months after the new one was bought, the one that was bought did 1.5% worse than the one that was sold. Over a year, it was 3.5%, and kept growing over 2 years, it was nearly 4% worse. This is before commissions, before bid-ask spreads, it's before taxes, simply in terms of raw performance. On average, we are going out there and picking stocks that are worse than the ones that we sold. No wonder we're having trouble beating the market. Now, there are a million behavioral explanations for this. We typically buy stuff when we should be selling, and we sell things when we should be buying. And we could explore those if you want in the discussions we have later this morning. But basically, this is one of the big reasons why we have such trouble beating the market. So another way of testing this same phenomenon, the fact that the average thing we do is a mistake, is what we do is we created a number of frozen portfolios at the beginning of each year, and then over that subsequent year, look to see how those frozen portfolios did relative to the actual trading portfolios that those same advisors ended up trading during the year. So we take all the advisors we track, and at the beginning of the year, we know what their portfolio looks like. We say, okay, that frozen portfolio is going to stay in place for 12 months. Then at the end of the 12 months, we look to see how that frozen portfolio did relative to the trading portfolio that the advisor actually executed with whatever he had in place as of the beginning of the year. If his trading portfolio added value, that he should be further ahead at the end of the year than the frozen portfolio. Pretty straightforward. So here are the results. So this is over the last decade. It turns out that among newsletters, the frozen portfolios on average was a little over 0.7 of a percentage point better than the frozen portfolios. Interestingly enough, there's a citation here at the bottom which is slightly blacked out, but basically there was an academic study that used the same methodology among mutual funds and found it was slightly larger, but again within statistical tolerances, the same conclusion among mutual funds. So it's over 0.7 of a percentage point on average that is the cost of the trading behavior of these advisors or mutual funds during the year. And you think about it, that's just devastating. Basically, we would be better off if we did nothing. Yeah? So say more about that, and then I'll repeat it to the group.
Of late, in the last few years, where we've had a pretty steady market, I think, oh my God, this thing's is gonna roll over, so I'll sell that and perhaps buy something else, and sometimes just stay in cash. And the result has been, if you look at it months later, I should have just done nothing.
Right. So you all got to hear that. That's wonderful. Thank you. I spoke this a number of years ago at the AAII chapter in Kansas City, and the reason I was thinking about it is that one of the people in the audience was the chair of the psychology department at Kansas University in Lawrence, just down the road, and he was so mad at me for saying this, and he was sure I was wrong. So he went back and started keeping track of it on a systematic basis because he was one of these very careful people. I think most of us are this way. We keep track of all our purchases and sales. And I ended up speaking at that chapter a number of years later. And in the question and answer, I had, called on everyone. And one of them was this guy, and I didn't know who it was. And he said, I wanted to tell you, I was more mad at you than at anyone. You went on through a long invective, but then basically said, I have to tell you, you were right. I went back and looked at all my trades and found that on average, every one of the times I sold and then replaced with something else, I was worse off than if I had done nothing. I gave this talk to, I've been on the boards of several small colleges. And so they usually put me on the endowment committee to look at their endowment. And I gave a talk to the endowment, all the people on the endowment committee. And again, you can imagine, people don't like to be told that the average thing they do is a mistake. It's not something that's going to create a lot of love for you, right? So again, there was a lot of anger. And one of them went back to his particular college and looked. And he came back and he said, guess what? You're right. The average thing that endowment had undertaken was a mistake. So again, it's back to something I said at the beginning. The first step towards wisdom is to realize that these odds apply to us. Because we, I think, as a general rule, have this ability to recognize the general truth of these statistics. I mean, God knows this is not the first time you've been told that it's difficult to beat the market, right? And yet, when you actually look at our behavior, it's not consonant with actually taking that belief to heart. We, in effect, think that the rules don't apply to us. So we need to remind ourselves, you know what, the rules do apply to us. Yeah.
One of the reasons why the endowment fund guy made such mistakes was he was being paid to do something. And if he didn't do any trading at all and just sat there and collected a check for doing nothing, he would have gotten into big trouble. So he had to show he was doing something.
Right.
Even though it was wrong.
Yeah, no, that's the point's very well taken. Though I'm going to come back to the part of endowment because I'm not sure it applies to endowment so much. But it's absolutely true. Look, if you have a newsletter, you're paying the newsletter guy $200, $250 a year, and every issue says, well, guess what? Just stick with your portfolios. You're doing fine. I mean, you're not actually at that point inclined to go look at his performance, which you should. But instead, you'll think, why do I pay this guy for doing nothing, right? So now endowments, in my experience, most college boards don't actually look at how much trading's going on. They just want to know the performance. But in the same way with a mutual fund. I mean, a lot of mutual funds, how many people know most of us, I'm sure, own mutual funds. How many of you know how many trades your mutual fund manager has made over the last 30 days or 60 days? I don't think any of us knows, right? You know? Oh. Okay, go ahead.
Because it's the original decision that you're advocating staying with.
Right. No, fair enough. I don't know whether you heard. Did you hear that? That basically you were asking a question of what decisions are used when you buy a subsequent stock that are different than the decisions that are made when you sold the previous one, right? And that there's a whole other workshop on that. My wife's a clinical psychologist, and she could go into that. But basically, when you're selling a stock, your motivations and incentives are often different than when you're buying. Because on the buying side, you have hope. The triumph of hope over experience is a very powerful force. And then the fact that you can't deal with losses oftentimes is a motivation for selling the stock. There are a whole host of, this is what behavioral economics spends all their time looking at, why we do the things we do. Now, I think even without all these behavioral biases, we'd have difficulty beating the market. So the amount of randomness that's in the world is huge, especially in the stock market, and yet we make it worse with our behavior. So I don't want to make it look like if you get rid of our irrational behaviors, we would all beat the market. We'd do better, believe it or not, a lot better, as we can see here, but it's still, and we're going to go into a couple of slides now, but we'd still have difficulty. So now it's okay, but up to this point, you might say, I'm going to go back. I find that as soon as I put a new overhead on, I lose everybody in the audience, which I hate. So basically, a good comeback to me at this point might be, you're talking about the mass of advisors in average, many of which are terrible. And we know they're terrible. But what if we only focus on those that have beaten the market over the long term? Let's say that we had a room full of only Warren Buffetts. Wouldn't we want to actually pay attention to what those Warren Buffetts would say? Fair enough comeback. So I now want to focus on, what if we exclude that 95% of advisors who don't beat the market and focus only on that small subset who've shown ability to beat the market? So here's, I think, one of the more overwhelming responses to that. And that is, I took all rankings of newsletters on a yearly basis and paired them with their rankings in the subsequent years. So let's say in 1990, a newsletter was in the top decile. Okay? And then I looked to see in 1991 what decile that top performer was. And I paired up all decile rankings of all advisors for every year going back to 1980. So you can imagine I have tens of thousands of pairs. So the first half of every pair is the decile of their ranking in year one, and the second half of the pair is their decile ranking in the next year, right? So if indeed being in the top decile is going to increase your odds of success, which is the hope in the comeback to me and say, let's focus on the top performers, you should find that in year two, that on average, the top decile from year one will be in a much higher percentage than will be in the top decile in year two. Does that follow? Well, so look at it. So now, look, guess what? That red line is what you'd expect on randomness alone, right? So here's the average percentile rank in year T plus 1 of the top decile in year T. So guess what? The average of the top decile is a percentile ranking of about 51%. Statistically indistinguishable from 50%. So in other words, and look at it, it's all statistically within tolerance of 50% in year T plus 1. The only one that turns out to have any marginal statistical significance is the worst decile performers in year 1. And it turns out that they have an above average chance of being a low decile performer in year T plus 1. So that's one of the things that emerges from my work is there's more statistical robustness at the bottom of the rankings than at the top. So on my epitaph, when I die on the gravestone, it could say, I help people avoid the worst performers, right? Not something that you want to put in neon and claim that was a reason for living, your purpose in life. I think that, one can dismiss that as not very important. It's pretty important to avoid the worst. But nonetheless, it turns out that if you focus your attention on the top of the rankings, you're not increasing your odds very much. Yes, sir. Right. So the question is, should you subscribe to the worst performers and do the opposite? Well, that is actually a nice segue into what we're going to talk about after the break, because that's the essence of contrarian analysis, right? But it turns out that that insight doesn't get you very far, even though it's on the right track. And the reason it doesn't get you very far is that there's more than one way of doing the opposite of a bad performer, right? You can do the opposite of a terrible performer and still be terrible. Or as my wife tells me, the clinical psychologist, she often reminds me, the opposite of stupid is still stupid. So, right? So don't think that you have some easy way of going about this. So dismal. And I think the answer, we've all been dancing around it in our discussions up to this point, is that luck plays a far bigger role than skill, far bigger role than we imagined. And our psychology makes things even worse. So this is back to what we were talking about. Our psychology makes them worse, but even regardless of our psychology, it's still mostly luck rather than skill that is a factor in our performance. So in fact, it's a perfect storm out there. It's mostly random, at least the shorter term movements in the market. And coupled with that, we tend to impute onto that randomness patterns, and then we act on those patterns from behavioral motivations, which make it even worse. So you'd think that if it's all random, after all, and we're just picking stocks basically for nothing that improves on it, because randomness by definition can't be improved on, then you'd think that our performance on average would be random until you take commissions into account. So then you'd think that our performance relative to the market would be the market minus the total transaction costs of all of us. But it's even worse. And that's what's so amazing. So anyway, but let's look at this role of luck. So it turns out that a number of people have tried to measure luck and the role luck plays in investment performance. And one of them I just want to highlight is a guy he's a visiting professor at Caltech. And his approach was simple, very simple, which is that you compare the variance of returns over shorter and longer periods. And the reason that that's so simple, I was just amazed when I read it. It's basically, he's saying that if you take any group of advisors and look at what their volatility of returns is, let's say over a 1-year period, and then the volatility of returns of those same advisors over, let's say, a 15 or a 20-year period, the difference in volatility can't be because of skill, right? Because you got the same advisors. So the difference has to be due to luck. So you look at the difference in variance, and it's a little more complicated of a formula, but if anyone's interested, I can give you the citation. It's out on the Social Science Research Network. You can take this formula and apply it to any database you want, but it turns out that when you apply it, guess what? He found that 92% of the cross-sectional variation in mutual fund performance is due to luck, leaving 8% to skill. I took that formula and applied it to my newsletter database and reached almost the identical result, just under 92%. Again, we should all be I should be hearing audible gasps throughout the room, right? This means that most of what we're doing is focused on around 8, can have an impact of around 8% of our performance, at best. Yes, sir. You mean small cap advisors? Yes, and it's no different. Right. So, anyway, so many different directions I can go with that one, but let me come back to that one. So 92% is due to luck, give or take. I don't think it makes a big difference if it's 91% or 93%. But basically, what would it mean if you were, let's say, one thing I always like to start is a rhetorical question. What if we named our organization the American Association of Individual Gamblers? That's what we're doing, right? And yet, this is partly back to the whole behavioral aspect of it. We think of ourselves as rational, statistically based, objective investors. We're not gamblers. Gamblers are those day traders and the people on CNBC and the fluff that Lynn started about in the introduction. They're the gamblers, but we're not. And that, I think, is actually a dangerous conceit. Because I don't think that the odds are different for us than it is for them. And that's really hard for us to take. It's like going to a horse race and you're the one who has done all the statistics and looked at the records of the horses and looked at the weather and compared it to who is the jockey on each of the horses, and you get it all and you rationally bet. And then here's somebody who's betting on the name. I like that name of the horse, or the color of his, And it turns out that there's and they've studied this, it's the bet, the house bet that you're trying to, the house odds are based on all those bets of those irrational people. And yet, it's hard to beat the house. The stock market basically reflects all of those bets of these people who are gamblers that we recognize very much as gamblers. And yet, it's hard to beat. Yeah.
Stay away from, whereas a gambler can't identify the worst blackjack tables.
Right. So so this is an interesting point. It turns out that you can do better than the worst and still not beat the market. So let's say that so there's a 1 out of 20 chance, or whatever the statistic is, that I think you could beat the market by picking a random. What if I could make it so that you have a 1 out of 5 chance of beating the market? I'm just making up orders of magnitude. So instead of your odds of beating the market are 5% by picking an advisor, the odds have increased a factor of 4 to 20%. Still means there's an 80% chance you're not going to beat the market. And I think it's something like that that's going on here. I mean, if I were trying to submit this as a PhD dissertation, I might, you should look at the R-squareds and that are in a lot of these dissertations. It's amazing. Look at the FDA applications of most drugs. It's very sobering how small the increase is. I should be able to get a dissertation claiming I have increased your odds by a factor of 4 of beating the market. I think, oh my gosh, she's a genius. And yet, fact of the matter is that still, you should not act on that advice. You should still go with an index fund. Yeah. Oh. Oh, and the formula here, I probably won't go off on that tangent now, but I'll get you the citation of the study. So, but I don't. Is it the be all and the end all of trying to measure luck? No, he's just looking at the variance at a 15-year, the cross section of returns at a 15 versus at a 1 year, and then look at what the difference is. So, I'll send you the paper.
Right here.
Yeah. I'll repeat the question. So you're relating it to, there's a whole literature on the reason to diversify over time as well as across stocks is that a lot of these swings will even themselves out over time. We're going to actually have a screen on that later. I don't think that necessarily applies to an individual advisor. It does to an individual stock, and it does to the stock market as a whole. But I mean, the difference, what Cornell's point is that you look at it as to how much is due to skill and how much of it is due to luck. You draw a different conclusion. That doesn't mean you shouldn't diversify. But, okay, you had a question.
Yes. What is the actual definition of cross-sectional variation?
Oh, you just take the whole distribution of funds, so over a 15-year period, and you look at what the variance of the return is. So you want to see what's the dispersion, is another way of looking at it. If you were to look at a bell curve, how broad is the distribution of returns? And then over 1 year, you do the same thing. And so, as you can expect, there's going to be a much greater dispersion of returns over a 1 year than over a 15-year period. And that difference, Cornell's suggestion is a function of luck rather than skill, since you're dealing with the same advisors. Okay, so there's another way in which a guy has approached luck. And this is a guy, I don't know how to pronounce his last name, but he was actually an assistant to Bill Miller. Remember Bill Miller at Legg Mason Value Trust, who had the longest run of beating the S&P 500 in successive years. I think it was up to 13 years. And then he went to Credit Suisse. He has a book out, which I recommend highly, which I'll give you the citation to in a minute, that basically his measurement is the quicker something regresses to the mean is a function of luck. So if something is mostly luck, you expect regression to the mean to be instant. And if it takes a long time or never to regress to the mean, then you're dealing with skill. And there are ways of measuring the speed with which something regresses to the mean. And that's a function that helps you measure the degree to which luck is going on. So he applied this measurement. His book is about both sports as well as investing. There's the citation of the book. It's called The Success Equation, Untangling Skill and Luck in Business, Sports, and Investing. And he then created this little chart to explain the relative roles of skill and luck. So if you go over here, that end of the spectrum is pure skill. Over here is pure luck. As you can imagine, there you have, at the far end of the spectrum, you have a roulette wheel or a slot machine. Over at the far side, it didn't show up on this, but there's a chess man is right over here. So basically, if I go and play a grandmaster on chess, and he beats me, of course, and the next round he's going to beat me, and the next round he's going to beat me, there'll be never a regression to the mean, right? Whereas if I go in and win on the roulette wheel, I'll lose the next time almost certainly, right? So there's regression to the mean is instant here, and at chess is hardly ever. So where did he put? Stock market, again, is very similar to what Brad Cornell found at Caltech, which was that it's, give or take 5 or 10%, you could say is due to skill, and the rest is due to luck. So anyway, I love this quote. I put it up here. Basically, Ben Graham said, and this is an amazing admission. This came at the end of his life. He said, one lucky break or one supremely shrewd decision, and then in between the dashes, can we tell them apart, may count for more than a lifetime of journeyman efforts. And I think it's worth remembering when he said this. It turns out that you may recall, if you know the history of his career, up until the last couple of years, he was behind the market. And then he made a bet on Geico that broke every one of his rules. See, this is depressing for those of us who think we want to be a rule-following investor, right? He put, I forget, at one point it was up nearly half of his portfolio into Geico. Broke every rule of diversification that he had. And Geico lost a huge amount of money, and he put more money into it. So he kept betting on it, and it turns out that Geico turned around and shot up. It was right. He made a great, ludicrous, you'd say, irrational bet on Geico, or rational. Again, the question is, how do you tell those apart? And it worked out in his case, and that's the reason we read Benjamin Graham's book today. For Christmas, I gave my daughters tickets to see Hamilton, the musical in New York. And there's this great song in there that it's a refrain that repeats itself throughout the musical, which is, who lives, who dies, who tells your story? The whole point is that Hamilton, his story didn't get told until much later, due to a variety of circumstances. But it is a very profound question. Who lives, who dies, who tells your story? We read about Ben Graham and we'll see a tagline that he beat the market over a 40-year period or whatever period his career was. But if Geico had not turned around that one stock, and it was due to accounting irregularities, and did Ben Graham know about the accounting that Geico was using? Of course not. He didn't go into that level of detail. If it hadn't turned around, and of course it couldn't have turned around, we would never know of Ben Graham today. Reminds me, I got a little frustrated, or more, depending on my mood, with Warren Buffett, who's one of his principles is don't invest in anything you don't understand. He invested in Goldman Sachs during the financial crisis, and he testified. You may all recall this. And the senators or representatives, I forget which House of Congress he was testifying before, said, do you understand these derivatives that they're investing in? No. Well, excuse me, one of your cardinal principles that you understand what you invest in. So he broke his rule. Now, he made money, but was that dumb luck? Or was it that he was a shrewd decision? This gets back to Graham's point that you can spend a lifetime doing things right, and no one will ever tell your story. And you have somebody else who breaks the rules, makes money, their name is in neon. Of course, that's CNBC's business model, right? You interview somebody whose name is in neon because they have had a good year or a good 5 years, and they're at the top of the ranking. But the question is it luck or is it shrewd decision? And as Ben Graham admitted, it's a huge concession at the end of his life to say that. Yeah.
So you mentioned Warren Buffett. Does Berkshire Hathaway belong in that 5% then of like an does that belong in 5% of beating the market?
Yeah, the question is well, you heard the question. So, yes, Warren Buffett, if you look at the book value of Berkshire Hathaway over the last 50 years, it has beaten the market. Interestingly enough, it has not beaten the market. You know the statistics as well as I do. I mean, it's over the last 10 or 15 years, the book value hasn't done as well. But if you look over the entire period of time, he has beaten the market. Yeah. So, but the question, let's say you went back 15 years ago and did a sort on all advisors, and you include Warren Buffett in that, you would have said, okay, Warren Buffett is clearly one of the geniuses, so I'm going to follow him. You wouldn't have beaten the market over the last 15 years. Okay, so the lessons learned. So back to this notion that the greatest robustness is at the bottom of the rankings. Lesson number one is don't do something stupid. Avoiding the biggest mistakes is probably the most important thing we can do. And that's because the strongest statistical patterns are among the worst performers. In other words, I can give you a greater odds that a bad performer will remain a bad performer than that a good performer will remain a good performer. So to go back to that chess analogy, you know that I'll lose to a chess grandmaster or to Watson's Big Blue computer or whatever it is. You know it, right? That you can give good odds on. But if I happen to have beaten in a given year a grandmaster, which is unlikely, chances are that I'll never be able to do it again. So again, some more lessons I think that apply to this. Don't just do something, sit there. This is we talked about this earlier. Is that the fewer things you do, the better. And then if you nevertheless do decide to do something, do so for reasons and trading rules that you have specified in advance, not how you feel in the moment. And again, these are things that we all know. Part of me is embarrassed that I'm spending your Saturday morning talking about these things because we all know it. But well, we're going to talk about some more of those implications. But another way of putting that is that if you don't have compelling reasons to deviate from buy and hold, yes. And another implication that we can talk about more later, but and this I got from Harry Brown. You may recall he had a number of books and newsletter in the 70s and 80s, and then became the Libertarian Party candidate for president in, I think, a couple of elections, late 90s and the early part of this century. And he recommended that you go out and create two separate portfolios. One a permanent portfolio and the other a variable. He called it a variable or speculative portfolio. The permanent portfolio is your buy and hold portfolio, and then your variable portfolio is the one you play around with. He says the reason you do that is you need to be psychologically realistic, is that we like to play around with our money. Just do it in a way that it's not going to devastate your retirement if you make a mistake. And know that your variable portfolio, odds are, is not going to do as well as your permanent portfolio. But the fact that we're all out here on a Saturday morning is testament to the fact that we like to play with our money, right? If you all believed in buy and hold, we wouldn't be spending our Saturday mornings talking about this, right? So, and there's nothing wrong with that. It's just do it in a way that A, increases your odds of success, and B, if you make a mistake, which is likely, that you don't end up having devastating consequences to your portfolio. Yeah?
And he made the comment that he sees a lot of people that are using their money for entertainment rather than being rational.
Right. And I would agree, and there's nothing wrong with that. I mean, you go to if you go to a casino and say, okay, I'm going to, put a stop loss on the casino. After I've lost $200, I'm leaving. And most of us, though, don't, right? Oh, just one more bet, I'm going to make it up, or whatever it is. But if we were to actually do it and say, hey, I'm going to the casino for entertainment, it's a fun evening, and, I'll make sure I don't lose more than what I can, otherwise I would have spent going to do whatever else, the world's not a worse place, I don't think. Same way that if you realize that you're in the market because it's fun, I think it's one of the most intellectually challenging pursuits on the face of the planet. We're basically pitting ourselves against millions of other investors. And can we beat the collective wisdom of all those other investors? And on the face of it, thinks we should be able to do it. And that's what draws us in. Same way with that horse race analogy, is that you see these people out there betting on the most ridiculous and irrational things. We should be able to beat them without question, and yet most of us don't. And that, of course, then fires up this urge that, oh my gosh, if I only did it better, or if I only did this differently, I'd be able to beat the market. So that's what keeps us going back. But to reckon, if it's all for entertainment, no big deal. And that's what I think is the genius behind Harry Brown's recommendation. Take your two portfolios and divide it up, and one of them, put it whatever restrictions are necessary to prevent you from actually trading it, and trade your variable portfolio. So at least you're doing something. So you have that part of your psyche responded to. But you just need to tie yourself, again, to use a Greek analogy, tie yourself to the mast to avoid the siren song. Yeah.
I would ask the question, have these analyses been applied to people who really know and understand the companies they're investing in? And I don't mean by SSG charts and that kind of thing. I mean, they follow the industry, they know who the players are, they know the management style, they read about the company every day. I would like to believe that changes the randomness of the investing question, but I'd be interested to what you have to say on that.
Well, so I mean, the question of people who really understand what they're doing. So let's pick the people who most clearly understand, presumably, and that's corporate insiders, right? Okay, so we're okay. Now, no, you're absolutely right. So corporate insiders, I mean, there's evidence that they do beat the market on their trades, okay? So, yes, if you have inside knowledge, it can help you. I'm not sure what that good, or how much good that does to you or me, but nonetheless, it is true that if you had market knowledge that the market doesn't have, that can help you. Though, interestingly enough, the government defines corporate insiders to include officers, directors, and anyone who's a 10% or larger shareholder. So let's say you're a 10% or larger shareholder. You'd probably, if I hadn't given you this preface, said that would be an insider, right? If I own 10% or more of a company, you'd have to believe, and I think all of us would agree, we'd know about what's going on in that company. The 10% or larger shareholders do not, on average, beat the market.
I wouldn't use corporate insider to answer the question for the following reason. Many, many people inside companies have to continue to divest their holdings so they don't have too much of one thing. And other people turn their portfolios over to the big investors for totally different reasons. I would take it down a notch And for those people, like I consider myself kind of an expert in technology because I've literally grown up in the Valley, at least in my professional career. And so I've been pretty successful at picking the companies that have done pretty well. And I don't think it's as random for me as it might have been for others. I'll just leave it at that.
Right. No, and that's very fair. I mean, so but I'll just make one more comment about insiders. You're right. They have to divest for reasons having nothing to do with their investment decision about their company. And yet you can take a subset of those transactions that they make that clearly are a reflection of their belief in the market, and that's when they buy with their own money. So if they are given as part of their compensation package a lot of options, of course they're going to exercise the options. They have to send a kid to school or whatever it is. But when they take their money and go out and buy more stock, that presumably is a pure reflection of what they think. And yes, they do beat the market. But when you go outside of that, it's hard for me to stand here and say, that, and I'm not going to say that your experience is random. But if you were to take a whole group of people who have close knowledge of, studied all their life, and yet don't have inside knowledge, on average, they haven't beaten the market. So I'd say either you have even more special knowledge than the average, or luck has played a big role. And I don't mean to be so, that sounds critical. I mean, but that's what my analysis would suggest. So.
I would have an example that is sector funds. Because presumably the managers of sector funds, since they're in a specific sector, know everything in that sector.
Yeah, no, I don't know whether you heard it, but your point, well taken, is that sector funds would be a good illustration of this what we're discussing, is that, you have somebody as a manager of a Fidelity Select fund, his or her job is to know more about that sector than anyone else, and yet sector funds on average don't beat the market. So, another reason that, this goes a little bit far afield, but it's relevant, in the Wall Street Journal today I have a column on what's known as the winner-take-all economy, which is a notion that because of changes in the overall economic playing field, but in particular in tech, that it's much more likely that a few firms will dominate each sector rather than have many relatively profitable players. But it'll just be one or two. And there are a number of logics that lead to that, which is what the column is about. But you look at the statistics, it's over one thing I went back to 1975, how much of the total profitability of American corporations came from the top 100 companies in 1975 versus today. And it's overwhelming. There's a chart in it, I'll just tell you. It's up to 84.2% now. 84% of the profits of all American publicly traded corporations come from the top 100 companies. It was half that in 1975. And that is a phenomenon, again, of this winner-take-all. And in fact, the other thing that's interesting along this line, which is in the column, is the number of publicly traded corporations in this country is plummeting. It's down to less than 4,000. It was up to close to 8,000 20 years ago. And there are all kinds of implications of that. I just touch and put in a little advertisement for my column in today's Wall Street Journal. But it is back to this notion of it's going to be harder and harder, I think, to pick that one winner. And the recommendation then is to, at least what I talk about with the professors I talked about in the column, is that it's more and more compelling than you need to buy the whole sector, because missing that one winner is going to have greater implications than it's ever had before. Well, no, the argument for why winner take all is that the professor I quoted, is a guy at Dartmouth, says that he calls it network effects, that as more and more people join a network, it becomes more profitable. More worthwhile to other users, that it attracts more users, and the profit margins of that company will grow because most of the costs of that company to maintain that network are fixed. So you basically have this, he called it a virtuous cycle, that you'll have one or two huge networks dominating an industry. And network is defined fairly broadly, and I don't want to go too far off on this tangent, but basically it's that which is labeled as the underlying motivation for why we will see more and more winner take all. And so you look at an IPO like Snap, for example. Clearly, people are betting that it'll be the dominant player. But the odds are that it won't, right? Because in a winner-take-all economy, by definition, most are losers, right? And so you may be right if you bet on Snap, but the chances are that you'll be wrong. And unless you have some ability in advance, this is back to your question, of picking who that winner will be, you better invest in the whole industry or the whole economy. Yeah.
So to return to newsletters for a moment.
Thank you.
Looking back, were there any characteristics of the 5% winners that you could extract that would allow us to pick newsletters today?
No,
or is it a matter of 5% we're going to beat, and it was pretty much random which ones it was going to beat?
Okay, well, it's a great segue into, so thank you for bringing me back on task here. So it's a little bit of both. We're going to talk about some of those characteristics. But as you know from that chart where I look at the regression of the mean, is that even the top decile of performers in 1 year are close to, on average, at the 50 percentile in the ranking for the next year. So even among the top performers, you'd have to say luck is a major, major component of their performance. So looking at, the same way, let's say you had a group of monkeys flipping coins, you'd have one who will have flipped 10 in a row, and everyone on CNBC would be to go interview that monkey and say, what is your secret to your success, right? That's not far from their business model, actually. Yeah.
Yeah, so I'm just curious, like, would you say that the implication of all of this is that if you can't measure your risk objectively, then you shouldn't be putting your money at risk at all? I mean, if you give your money to someone you don't know what they're trading in, what their techniques are, I mean, you're just basically going on what the perception is, as opposed to if you're trading something, you're setting your stops correctly, you can actually quantifiably measure your risk, and then from there you have a basis, right?
Well, I would say, I would agree that
because it's basically the reverse of what Las Vegas would do, right? They would say, we'll give up the big fish, but we'll take a lot of little fish, and over the long run, we end up making money. So it's kind of the reverse of what you would want to do as an investor or trader. So in even to the point of what Warren Buffett says, the first big rule is not to lose money, right? So there's 4 things you can do. You can make a lot of money, you can lose a lot of money, you can make a little money, lose a little bit. You just want to avoid losing a lot.
Right.
The other 3 are, over time, they would sort themselves out.
Yeah, there's a lot I agree with. I think back to your point about the knowing and measuring your risk, I think that's a prerequisite for an analysis of how you're doing. And most of us, when we do well, we tend to rewrite history as though it's our genius. And if we do poorly, we strike it up to luck. I mean, an analogy I find is golf. I'm not a golfer, so you may tell me I get this wrong. But basically, as I understand it, after a golf round, everyone in the clubhouse, or the 19th hole, or whatever they call it, everyone will be bragging about that great chip shot on the 7th hole, or the great putt, or whatever. And then if I were there in the clubhouse, I'd be playing the functional equivalent of saying, well, but did you beat par, right? And very few of us beat par. And so no one invites me to the clubhouse for that very reason, right? And so, which is why I'm not particularly popular in the advisory world either. So so we tend to rewrite history, and I think what I hear you saying is we need to avoid the rewriting of history if we're going to have an acceptable analysis of what's going on. So I have no idea how we're doing on time here. So we have 15 minutes. So let me go through a couple more slides. So another discipline, this is back to the other part of the question of what do you do with this. So among the 5% that have done well, insofar as we think they've done something better than just been lucky, I think one thing that does emerge is that patience is a virtue. And that's because no one is able to beat the market all the time. And the reason that's a conclusion that I think emerges is that even if you take this 5% that have beaten the market, they haven't beaten the market every year. And that's crucial. So if you got rid of it because it wasn't doing particularly well, you would probably have given up at the wrong time. Yeah.
I've been around a long time, as you can tell by looking at me. But Magellan was a big deal a long time ago, And I think he beat the market for quite a few years, and then he quit while he was ahead. I don't think there's more information available on that. I don't think there's going to be opportunity for another Magellan. Would you agree with that?
Well, an opportunity, you mean that somebody like, so in other words, if I hear you're saying you don't think Peter Lynch operating today would be able to beat the market?
Yes.
Right.
That's my question.
Well, there are a number of reasons why I think that's correct. But yes. I'll go off a little bit on a tangent with Magellan. Lynch supposedly said, and this I heard third hand, so I have to qualify that I didn't hear him say this, but Lynch, during the time that he was managing, was the most successful equity fund, bar none, in the U.S. up until the early 90s, I think, which is when he quit. He said that more than half the people who've ever invested in Magellan have lost money, and which is a mind-blowing phenomenon, which is to say that, everyone who invested, you take that group of people who've ever had money in Magellan, more than half of them lost money. And the reason, his point is that most people go into Magellan after it's rallied, and it gets out after the market drops, which is just the opposite of what we should be doing. And I was writing for Forbes at the time this came out, so I wrote a Forbes column on it, and Fidelity immediately responded and said, that's not true. I said, oh, excuse me, I'll run a correction. What is the number of, what is the percentage of Magellan investors who have lost money? And they said they didn't know, which makes me wonder how in the world they would have known that it was wrong. But nonetheless, we know that the general phenomenon is true. Take the mutual fund that has made more money than any over the last 37 years, and that's the prudent speculator, John Buckingham. He used to be Al Frank before he passed away 15 years ago. Made more money, there's no question about it. And yet I am perfectly willing to believe that more than half the people who've ever invested in prudent speculators' portfolio have lost money. And I know because when I started following in 1980, Al Frank said he had 75 subscribers. At the top of the market before the crash of 87, he had 5,000 subscribers. Then the market dropped, as you recall, and his portfolio in the crash of 87 lost 59% in one day. At which point, most of the people who came in near the top had a loss of close to 59%. You were ahead of the market if you'd been in since 1980. So a lot of those people who got in at the top and then lost 59% in one day and got rid of them think I'm the worst contribution the investment industry has ever had, right? Because they just lost a huge amount of money by going with the top performer. So this is back to this point about how patience is absolutely essential if you're going to follow a top performer. You need to give that top performer a long enough leash to be able to show his or her stuff. And that's the corollary, again, is that you shouldn't give up on a strategy just because it lags the market along the way. And that's a high hurdle. I want to talk about a little bit about that now. Since losing money and lagging the market are no strangers to market-beating advisors. So let's look at this. This is from S&P that they looked at. They looked at mutual funds. Then I did the same thing with investment newsletters. It was almost identical. So the blue bars right there are among those who've beaten that refers to the last 10 calendar years. This is the last 20 calendar years, and the percent of rolling 5-year periods is the red column. So I'm looking now only at market-beating advisors. So back to a couple of the questions you've asked, this chart only focuses on advisors who've beaten the market. So we're now down to a very small subset. And now we're looking at how often did they lose money. Over the last 10 years, they lost it about 20% of the time, which is to say around almost 2 out of the last 10 years, they actually lost money. Over the last 20 calendar years, it's at about 25%, or basically nearly 5 years out of the last 20. They've actually lost money. Same thing among in terms of lagging the market. You can imagine you can lag the market and still make money, but still, it's up to nearly 40% over the last 20 years of individual calendar years in which it lagged the market. And the reason that's important is a lot of investors, in my experience, are impatient, and they think that if you have lagged the market, then there must be something wrong. And usually, if your definition of success is never lagging the market, then it is something wrong. But if that is your criterion, then you're never going to find an advisor or strategy that you like, because they always will have a period of time in which they do not end up beating the market. So you have to be willing to not only lag the market, but to lose money along the way in order to follow a winning advisor. And then I have an illustration involving Value Line, which happens to be a rather timely thing, though it had nothing to do with it, just a coincidence. I understand you have a Value Line speaker in a subsequent meeting. So you look at, let's look at Value Line. So this is the record of the Group 1 stocks. So this is the 100 stocks that are ranked highest for timeliness. And every week they update that record. And we create a portfolio that follows that portfolio, pays commissions and transaction costs and so forth. What this graph does is look at its performance relative to the Wilshire 5000. So basically, it doesn't look at overall performance. It looks at cumulative outperformance or underperformance. So you can see through the 1980s and 1990s, it beat the market. Then, right before the internet boom, when value stocks were not being well rewarded, it dropped down, but then shot back up and was again almost to the same degree of outperformance by 2002. But starting in 2009, it's gone through almost uninterrupted period of losing ground relative to the market. So the question is, can you, using any of a number of statistical tests, determine that this is a reason why Value Line has lost its touch? So again, the number of tests I applied it to, so you just basically are looking, you look at all of that sample and this sample, and then you say, is there at the 95% level enough confidence that those are from different samples? Basically, if you were to be pulling ping pong balls out of a big bin and you said, oh, is this a different bin or not from the other, given the characteristics of the sample that you have? Guess what? At the 95% confidence level, you could not conclude that that's any different than the sample from which that is drawn. So you couldn't, at the 95% confidence level, say, you know what, you should be giving up on value. So there's two questions. I'll start with you up in the back. The Wilshire 5000 is that, and that's just basically the combined market cap of all stocks. Yeah.
Do you think that has anything to do with the high-speed trading recently?
The question is, do I think it has to do with high-speed trading? I don't have any idea. I mean, I would imagine it plays a role, but I don't know. There's so many factors involved in why a once profitable strategy might not continue to be profitable. Some of it is random variation. Some of it is luck. Some of it is the fact that something's working, attracts a lot of new money. And as it tries to extrapolate, try to exploit whatever factors that they were looking at originally that were making money for any of a number of reasons. So, but would high-frequency trading play a role? I would imagine, but I don't know. Yeah. Fair enough question. The question is, how many more years of this period starting in 2009 would you need in order to satisfy the test that you are now in a different era? And the answer depends on what those years look like. So if, let's say that you had a couple years, I mean, I'm just going to make some, it lost 75% of its money each year for several years. You wouldn't take many years of that to throw it out to say that that's a different sample. But usually something doesn't fall over a cliff. And this is part of the problem, is that it tends to, it tends to just not do as well. And it struggles. And that's so difficult, is how long do you stick with a struggling strategy? And our impulse is to go with another strategy that's not struggling because it's too painful to stick with a strategy that's struggling year after year, in this case, 7 years in a row. And yet, at that point, you're not basing it on rigorous statistics if you're making that decision. And that's the challenge that we face. So another lesson is we have to keep risk low. And I think this again follows, but it perhaps is not as obvious. Given the predominant role that luck plays in investment performance, it's crucial to keep risk low. That's because high risk inevitably leads to losses so big that recovery becomes unlikely. And so the next slide I want to focus on, but I want to tell you about it in advance. I just simply have a dot on a scatter plot that looks at risk over the last 20 years and return over the last 20 years. And you notice that once risk exceeds that of the overall market, just to use that as a benchmark, even the best performers earn very little extra risk. So contrary to that general principle that we earn more if we incur more risk, that's only true up to a certain point. And there's a very quick law of diminishing returns. And I think that diminishing returns comes because if luck plays as big of a role as we're talking about here, and you're taking a lot of risk, then inevitably there's going to be a time when you're going to lose big. That just follows logically. And insofar as you lose big, it becomes extremely difficult to ever battle yourself back to the point where you aren't below the market over the long term. For another column I just wrote this week, I looked at the inflation-adjusted return of the market since the dot-com high. So March 24th of 2000 was the all-time high before the market went down through the internet, the bursting of the internet bubble. So if you look at it on an inflation-adjusted, dividend-adjusted basis, since then the market has produced a 2.5% annualized return. If you had read in 2000, you picked up a copy of that great book, it's wonderful, by Jeremy Siegel at Wharton called Stocks for the Long Run. You would have said that over any long period of time in the past, you would have seen that the market outperforms inflation by about 7% annually. And yet here we are 17 years later, more than 17 years later, and we are not anywhere close to 7% annualized. At 7% annualized, it's incredible. You were going to double the purchasing power of your money every 10 years. At 2.5%, it's going to take you 30 years. So there's this question, okay, what past do you extrapolate? And I think, back to this point, is that if the future is anywhere close to what we're seeing now, it's even more of a reason to keep risk low. So let me show you this chart. So I don't know whether you can see the dots. I'm sorry, it's not very legible. But I have here the vertical line, the stock market's risk level. So I normalized everything so that 1.0 is the risk level of the market. And then I drew the best fit trend line, just per Excel, of all those charts. Notice that it's a downward trending line, which is to say that if all the information you had, nothing more, was risk and return over the last 20 years, you would have said the relationship between risk and return was negative, not a positive relationship. Another thing is, look at right there, I don't know if you can see it, that dot basically is right within tolerance level at the risk level of the market and has produced a 15% annualized return over a 20-year period. I think there's one, maybe two dots over here that are slightly above it. But so why would you go from 1% up to about 1.35 times the risk level of the market to get barely any increase in returns? And yet most of those who have risk level at that are way down here rather than up there. Another point about why to keep risk low. Yes, sir. Right. No, it fits right in. Another piece of data that fits in very nicely, there are a number of things that point to this, is you look at hedge funds. You could, hedge funds, the whole point is to reduce risk, right? So if you look at the average equity-oriented, so it's not looking at other markets, but an equity-oriented hedge fund over the last 20 years has done no better than a simple portfolio that's 60% equities, 40% bonds, which I assume would be along the lines of one of the more conservative portfolios in your analysis. So again, this is just, we're looking at many different implications and corollaries of this notion of that luck plays a big role in how difficult it is to be the market. We better not be taking a lot of risk if that's the case. Yeah.
A clarification. You just said a minute ago, that 7% was historical long term, and now it's been about 1.5 or 2 or whatever. But I thought that 7% had an inflation bias in it. And the reason we're so low is inflation's been so low.
No. The numbers I reported are on an inflation-adjusted basis. So from 1801 up to the turn of the century, according to Siegel, stocks have beaten inflation by 7% annualized. Since the top of the internet bubble in March of 2000, they've beaten it by 2.5% annualized. So basically, we're at about a third or less of the outperformance. Anyway, so how are we doing on time? We probably are close. I'm almost done with. So yet another reason to keep risk low is the future is far more unknowable. And now I want to end with this one next slide, and then we can take our break. So basically, I know this is all very depressing, so I have to apologize. But basically, another way of saying that, we keep dancing around the same thing, but the future is unknowable in most respects. And we don't really operate our life as though that level of uncertainty is there. So this is the chart. We get it from Siegel. We've seen it many times. It's the chart that every financial planner in the country trots out. And this is what you were talking about earlier about diversification over time. So basically, you look at the standard deviation of returns over a 1-year period of time, you have close to 18% a year. So if you were to go plus or minus 2 standard deviations and the average return of the market is 10% per year, give or take, that's saying that you at the 95% confidence level know that a return in any given year is going to be 10% plus or minus 36. So that's up to 46 or minus 26. So thank you very much. The market will be either down 26%, somewhere between minus 26 or plus 46 this year, right? So that doesn't tell you very much, right? That's incredible volatility. But yet, when you go out to a 30-year holding period, at least over this period back to 1801, notice how the standard deviation goes way down. So now we're down at around 2% standard deviation, which is to say plus or minus 4 percentage points a year you can at the 95% confidence level on the assumption the future is like the past. That will be the rate of return. And since you have a rate of return that's 7% on an inflation-adjusted basis, that's not bad. That the worst that you'll have in the next 30 years is you'll beat the market by 3 percentage points, and you could do as well as 11 percentage points ahead of inflation. And so that's the basis for this confidence that you get. I'll come back to you in a minute. That's the basis of the confidence. But the key assumption is the future going to be like the past? So how valid is this assumption? And there are people who have tried to measure this. And to consider all the forces that could prevent the equity markets over the next 30 years from equaling their annual average return. Might the range of possible consequences of those other forces actually increase with the time horizon? And as soon as you ask the question, it's of course they could, right? Think of all the things that could happen over the next 30 years. Do we really think that those will balance out such that the market will continue to rise at the same level? And how much confidence do we have that it'll increase? And the one example that one of these professors at the University of Chicago brought to me was climate change. So again, without getting into the debate, obviously I have one particular point of view on it, but the point of this is not to talk about climate change, but let's look at the range of possible economic consequences of climate change over the next 12 months. They're minuscule, right? We're talking about something that would be virtually undetectable at the 12-month horizon. Now think about it over the next 30 or 50-year time frames. They range, depending on your belief about what's happening to the climate, from either no change or no impact to the catastrophic. So then don't tell me that things are going to balance out over a 30-year period and will all work out. Basically, you're assuming by saying to extrapolate Siegel's 7% above inflation per year average over the next term, you're basically saying, I think that climate change is not going to impact. Well, I hope he's right. But how confident are we? And you realize that any one of these attempts to take the past statistics and extrapolate them into the future, we're assuming the future is going to be like the past. My graduate degree is in philosophy. One of my great favorite quotes is from David Hume, the Scottish philosopher. He says, all we know is that past futures were like past pasts. But how do we know that future futures will be like future pasts? And we don't. So anyway, this is a chart that this guy at University of Chicago and a guy at Wharton measured. They're not very popular with Jeremy Siegel, but basically what they do is they look at the variance relative to one-year holding period. So we saw how much variance there was at the one-year holding period per Siegel. Now, this is looked at, so that line there is the variance relative to that one-year variance. So obviously at 1 year, you have no difference. At 10 years, the additional variance, because of the uncertainty about the future, they estimated is 10% higher rather than lower. And look at that. At the 30-year horizon, it's 40% higher. 40% higher rather than dramatically lower. So basically, when we have this assumption that the future is going to be like the past, we are on shaky ground. What basically they say is that the past 200 years, the sample that Siegel focused on, could easily have turned out differently. Basically, the last 200 years was one draw of a sample. And we have many, many possible things we could have drawn out of that sample. The last 200 years represents our winning 2 world wars, the internet revolution, any of a number of things. They all went America's way. And it's sort of, unless you believe in sort of a Pax Americana that, we have some God-given preordained destiny, that things are going to all fall our way, we can't estimate that we're going to do that in the future. And this is the kicker, according to this guy at the University of Chicago who I interviewed, everything that is momentous that has gone our way over the last 200 years, not only would they have to go our way over the next 200 years, but by definition, we can't know any of them now. Because if we knew them now, they'd already be reflected in stock prices. So we have to have things as momentous as 2 world wars, a civil war, all those things you can imagine that have gone our way in the sense of what, helping equities, right? And we can't know them now. How confident are we that that will happen and they'll all fall our way? When I ask like this I want to curl up in a corner. Sorry, right? So just a reason to bring this up is I want us all to walk away from here to our break. And we're going to take a break here in a minute and come back, and we'll still pick ourselves up by the bootstraps and think about some of the things we can do. But nonetheless, we need to have a very healthy appreciation of the uncertainty and the luck and just the randomness that the markets have. Now, if every investor group I talked to was out there thinking that, they were all sort of curled up in a corner and going around, oh, woe is me, there's nothing I can do, then I would be giving an entirely different talk. But most investors, including AAII investors, they think that there's ways in which they can beat those odds. So that's the reason I come in and have this pedagogical force of saying, you know what? You're kidding yourselves. And, if you go out of here with a healthy awareness of just how uncertain things are, then I will have served, I think, a fairly healthy purpose here, which is to say the things that can affect your portfolio are far beyond your knowledge, and it's sort of a warped view of the past for us to think that we can increase our odds much more than marginally. So let me end it there. I think we're going to take a 15-minute break, and then we're going to talk about contrarian analysis in particular, which I think is one way in which we can emerge from this in not a completely helpless way.
We're ready for the second session.
Okay, well, thank you very much. It turns out I had a couple more slides that are part of the more depressing part of my presentation, but I wanted to nevertheless give them to you because I think they have some valuable information. Then we'll get into talking about contrarian analysis. This is also a section of the morning where I want as much discussion as you feel so inclined to have. So I don't want to keep talking forever, though my family tells me I have that ability. So we're talking about the uncertainty. And the other thing I just want you to, again, to be aware of, this is all part of, in the context of having a healthy appreciation for how many things can go wrong. And this I want to talk to is referred to in the business as path dependency. So it turns out your retirement wealth is a function not only of how the stock and bond or whatever market you focus on, how they perform over your lifetime, it's also a function of the path those markets take along the way. Drawdowns near your retirement age, for example, have a far bigger impact on your overall retirement wealth than drawdowns earlier in your life. Now that seems straightforward enough, but it's amazing how much implication it means. It means that you cannot, this is back to our conversation about risk that some of you were bringing up earlier, is that you need to much more manage your risk earlier in life than a typical financial planner would have you focus on, because it has a huge impact. And so this particular chart I have here comes from GMO, the Boston-based money management firm. It's fascinating. So actually, it turns out that if you look at over a period of time of 40 years, if you started in 1953 or in 1967, the stock and bond markets produced almost identical annualized returns on an inflation-adjusted basis. So this is a real-world example, though many parts of it are hypothetical, but real-world in terms of the returns for these two investors that they hypothetically constructed, Joe and Jane. And Joe started retirement in 1953, building up a retirement wealth in 1953. That's when his career started. And Jane started in 1967. But everything else about this simulation is identical. What their salaries were, how much of their salary they put in their 401k. Obviously, 401ks didn't exist back in 1953 or 67, but just follow along the example. So they put the same amount in, they deferred the same amount, they had the same match from their employers, and over their lifetimes, markets produced the same annualized return. And guess what? At retirement, after 40 years, Joe had $590,000, using this hypothetical example, whereas Jane had $880,000. It's an overwhelming difference. And again, it's just to add the level of uncertainty that we should all be aware of. I mean, even if we were to say, oh, well, assuming that stock and bond markets produce the same return over the next 30, 40 years, or whatever lifetime that you're focusing on investing over, as whatever you're assuming, you can still get that right and still not end up getting the retirement wealth that you think that you should have, or you would deserve relative to the performance of the markets over that period of time. Back to my golf analogy, you can do a heck of a lot of things right and miss that 2-inch gimme putt at the end. It doesn't matter. You still haven't beaten par. Yeah. Right.
I tend to agree with you that over the next 10, 15, 20 years at least, the rate of return is going to be lower than it's been in the past. That's just my gut feel. I'm curious, based on your experience, if you think there are going to be any other major differences in market performance, whether it's volatility or risk or whatever, going forward, because at least personally, I tend to think there are going to be changes due to the influence of technology. And I'm wondering if you think there are any others and what they'll be.
Yeah, well, I think a big one is what we were talking about with, in answer to the question you raised, was the winner-take-all economy, to use that as a catchword, is going to change the dynamics of the market. The evidence, that the implication, by the way, of that is that an individual stock will be more volatile than in the past. And there's evidence already of that emerging. And because of that, you need a bigger portfolio to diversify away the risk of individual stocks. Interestingly enough, if you look at the market as a whole compared to 50 years ago, it's no more volatile, though the individual stock is significantly more volatile than 50 years ago. And that is consistent with, the many factors presumably causing it, but that's consistent with this winner-take-all economy. I was mentioning one of those factoids about how many more publicly traded corporations existed even 20 years ago. It's dropped by half. And a lot of that is that most corporations in this country make only marginal profit or no profit at all. And that's a new development. If you were to look back 50 years ago, there was the leaders in an industry, the leadership was fairly broadly diversified among a broader group. Now it's one or two that dominate the industry and get the lion's share of the profits. If you end up not, so there's two things. If you pick one of those stocks that goes between marginally profitable and unprofitable, it's going to be a very volatile stock. And even if you happen to pick the winner, and then that winner stumbles, that's going to be very volatile too. So the estimates are that you need, to get the same level of risk reduction, you need twice as big of a portfolio now than you did as recently as 40 years ago. So anyway, so I want to focus now on contrarian analysis, hopefully as a way of not letting you all leave completely depressed. And so this is the reaction that you guys have had today is the same that a number of people have had over the years, which is, can't we just do the opposite of these people and make money? That's sort of the impulse. And I was saying earlier that that is correct as far as it goes, but there are ways in which you should and shouldn't go about doing contrarian analysis. And so the nugget of wisdom, as before, is that since the average thing we do is a mistake, that ought to be the basis of helping us do better than that, right? So if we find that the great mass of the investment world is, the prevailing wisdom is to do X, doing the opposite of X, and we have to define what that is, at least is in the gate of something that might be better than just random. In the same way, at the opposite end of the spectrum. And that's because another way of putting that is that our mistakes are not randomly distributed. We're all human beings. We all have similar psyches, and we are motivated by the same things. We're scared of fear, and we like getting wealthier. Basically fear and greed being two major emotions, and so we can exploit that. So again, that leads to that quote from Warren Buffett, where I think he's absolutely right. We should be greedy when others are fearful, and fearful when others are greedy. Now, there are a number of ways of exploring what this means, but it turns out, notice that most of the time that means that contrarian analysis probably is not going to help you very much. So you just need to know that going in. Most of the time, we're not at extremes. A lot of the times, people are sort of halfway in between. The markets as a whole, the prevailing sentiment is halfway in between the sentiments of fear and greed. But there are times when people are predominantly, the prevailing mood is overwhelmingly exuberant or greedy, or other times when exceedingly fearful. And if we can have ways of identifying those and do the opposite of them, we should be able to improve upon our returns. That's the hope behind contrarian analysis. Now, the reason that this only gets you so far is that it's easy to say we should be fearful when others are greedy, but how do we know? How do we really know when others are greedy? We often like to think, oh, well, everyone else out there is different than ourselves. So if we're fearful, we're going to say, look at all those people on CNBC. The amount of greed is overwhelming. Or if we're greedy, we say, look at all that fear out there. The market's going to climb this wall of worry, and I'm going to be making money from it. So we tend to see in the world what we want to see. And that means that contrarian analysis can easily become the excuse for very sloppy thinking. So we need to have an objective measure of sentiment. And there are many objective measures of sentiment. I have one of them that I think looks at it slightly different, which I'll talk about in a minute. But you've seen many of them over the years. In the newsletter space, you have Investors Intelligence that looks at the percentage of advisors that they monitor that are in one of three camps. They put them in a bullish camp, a bearish camp, or bullish but expecting a correction. That third camp is sort of in between. Then you have the AAII Survey, which all of you, I'm sure, very familiar with, where people self-report when they come to the website, whether they're bullish or bearish or expecting a correction. So you have that. You have any of a number of sentiment measures that come from the market, the exchanges themselves. So you have the VIX, for example, that looks at the expected volatility over a subsequent 30 days. You have the put-call ratio. There are any of a number of ways of looking at sentiment. And I'd say any objective measure is better than not having an objective measure. And my favorite example is I was the moderator of a panel discussion. This is many years ago. So it's not a current one. But every advisor who was on that panel, when I introduced him or her, they got up to say they were the only person that was going to say what they were about to say, and therefore they must be right. And So, and I kid you not, one of the persons on the panel thought that the Dow was going to go to 47. And does that mean it's right? What? 47. Period. 47. Yeah. And so, and you have another person, he wasn't on the panel, but, Dow 36,000 at the top of the internet bubble. And of course, it will get to 36,000 someday. The question is when. But that just because you are alone doesn't mean you're right. And that's where contrarian analysis gets so sloppy. Another thing people like to do is they say, well, look at that magazine cover. It's very bullish. Barron's is bullish this week. That must mean the market's going to go down or whatever. Well, that's one of those anecdotal stories that people like to tell. Back in the 1970s, you had Business Week that at the very top of the markets called it the rebirth of equities on their cover. And then at the bottom, they said the death of equities. And it's terrible for their marketing because they couldn't have gotten it more wrong. But that's a sample size of 2. And that has no statistical rigor to it whatsoever. And so the reason I think contrarian analysis is as popular as it is today, at least in name, is that it's a great marketing ploy, right? Because you are different than everyone else. Who wants to be alike everyone else? If you want to sell your subscriptions, you say, I am the only person who's going to give you this dose of wisdom. So if can you imagine, you say, well, I reflect the prevailing wisdom and talk about how you might, put that into practice in your portfolio or whatever. I mean, that's not a very good marketing ploy. So a lot of people claim they're contrarian, but in fact, very few people are in practice. And I think that is the key. I mean, a famous quote from the Baron Rothschild, which was, we need to buy when the blood is running in the streets. The blood was running in the streets when he was talking, but it's difficult to buy when everyone else is scared to death. How many people bought overnight after Donald Trump won the election? Dow was down 750. I mean, there was panic out there. How many bought on the morning after Brexit referendum was passed? How many bought right at the end of the 9/11, right as the market started trading after the 9/11 attacks? I mean, I'm not saying you should, but I'm saying that's what truly being a contrarian might take. Or in the individual stock area, buying a stock that has good fundamentals, we can talk about what that means, but is out of favor. To use a horse race analogy, it's an analogy that shows I'm not a good horse race bettor because I've never done it. But nonetheless, let's assume you could bet on all horses in a 10-horse race. I think you can only bet on the top 3, right? I maybe, again, betray my ignorance about this. But let's say that, so you have a crowd favorite, overwhelming odds to win, and that crowd favorite comes in 3rd, whereas the one who is in 10th place comes in 6th. It's very possible you could make more money by betting on that 10th place horse than by betting on the crowd favorite. And yet, the crowd favorite did do better than the one that was at the 10th place. So a contrarian ends up betting on some duds. But you just don't think they're that bad relative to the expectation of the market as to how bad they are. So basically you're saying they're not as bad as we think. That's not, again, a very sexy tagline for why you bought a stock. You want to buy a winner. You don't want to buy a loser, but not as bad as the loser everyone thinks they are, right? And that's an interesting contrast. Are we in this because we want to have our ego massaged because we like to say we bought winners? Or are we in it to make money? If we don't mind a portfolio filled with stocks that don't look very good and perhaps are losing money but aren't quite as bad as everyone thinks they are, then you're a true contrarian. In my experience, very few people are a true contrarian because it requires a level of courage that most people, it's uncommon, basically. And again, there's no shame in saying you don't have it. It's not easy to buy when Donald Trump just wins the election and the markets are down 750 points and you think, that all the predictions are that the market's going to crash even more. But that's what a contrarian ends up doing. So we need an objective measure of sentiment, and we need the discipline to actually do the opposite of it when you reach extremes, and have the discipline to say, most of the time, contrarian analysis doesn't help you, because most of the time the market's in between those extremes of fear and greed. But when it's at an extreme, those are times when it's helpful to do the opposite. So to make contrarian analysis objective, again, this is much of the what I was just saying, but subjective measures are dangerous. And by the way, I mean, I didn't mean, I had the last bullet point on that slide, which I very quickly rushed over. I didn't mean to make it a criticism of AAII, but a voluntary reporting survey is itself suspect, because the question is, why are people going to that website and reporting? Same way, I mean, this is not a criticism of MarketWatch, where my column's been for 15 years, but look at the comments that are associated with my column. I mean, I can't even let my kids read my own column on my website because the amount of invective and name calling and swearing, and it's just vile. But hopefully that's not representative of human nature. And so you ask the question of how representative is it of people who spend their time going to the AAII website to report whether bullish or bearish or expecting a correction. It may be okay, and indeed I've done some statistical tests to correlate my measures of sentiment with that, and there's, as you can expect, some high degrees of correlation, though there are some interesting divergences. But we want to be as objective as possible and then subject it to some tests to see, does it actually help? So what I have done is constructed 4 different sentiment indices on different parts of the market. I have 2 in the stock market, one that looks at a general domestic equity exposure, then a second one that looks at just among those market timers who try to time the NASDAQ market. Then I look at the gold and the domestic mod market. And basically the tests confirm at a modest level, we can talk about, it's not like it's going to make anyone rich overnight. The market does better following extreme low index readings than after extreme high ones. Those indices basically reflect one thing and one thing only, which is the average recommended exposure to the market among the market timers in that area. So I started out, as I was saying earlier, a number of advisors in 1980, and don't track all of them now because they haven't been around. But I look at anyone on my list who has recommends a short-term, basically a short-term market timer. So any percentage recommendation to the market, or whatever market that they're focusing on, if they have that recommendation and it's updated as often as daily, if they change their mind, I include it in an average. And at the end of the day, I average all those percentage exposure levels to come up with a single number, and that's what the index reading reflects. So it's objective. You can disagree with my interpretation. We're going to talk about my interpretation here in a minute. But the nice thing about it is that it's a fact. And I think insofar as we can start our analysis with facts, it's a good thing. And so you can say, are we more bullish out there right now among the advisory committee than we were yesterday or a week ago or a month ago or what have you? Then we're at least in the gate, at least, of being able to answer the question of, are we at an extreme? And so that's what these indices that I've created measure. And I don't know of any other that look at it quite in the same way. So this is now the, as of last night, I updated this. This is the average exposure to the domestic equity market among these short-term market timers. The red line, pressed the wrong button. So the red line is reflecting the average exposure. That's the index. And then the Dow is the blue line. God, I don't know what happened to the legend there. But anyway, so basically, red line exposure level, blue line is the Dow. So you can see there's the low and the correction in early 2016. Then you saw the general upward march of the market throughout the year, the dip right around the election time, and then the continued march upward since then. The thing that you should look at from an overall point of view, and I could focus on the last 20 years rather than the last couple years, but basically is that in general there's a fairly high degree of correlation there. So notice that low levels of exposure to the market, recommended exposure, correspond with relatively low levels for the market and turning points in the market. So right here are the 2 lowest levels that we've seen over the last 2.25 years, down at around negative 30% in each case. And each time, those coincided almost to the day, as it turns out, with turnarounds in the market. Now, some of them, the exposure level didn't get down that low, but went down relatively low, and then the market would keep on going and so forth after a more modest turnaround. What do I think about this right now? If I were to say where I think the where we stand. I think there is not the level of excessive bullish optimism right now that would cause a worry right now. I mean, we're not among the extreme of pessimism either. I think we're in one of these areas where we would not draw a conclusion one way or the other. But insofar as somebody were to conclude that there's too much bullishness out there, I would disagree with them. I'd say we're not seeing that excessive levels of bullishness. Excessive levels have been up as close to in the 70s and 80% range. Right now, as of last night's close, we're actually below 40%. So at least insofar as you're looking at the sample, the sample contains about closer to 100 of the short-term market timers, at least among them, and they, a broadly representative sample of a short-term market timing community. They are not all that bullish right now. And indeed, ever since around the turn of the year, in general, the market has kept going, and except for one little spike upwards in February, the trend line has been going down. So you hear saying among a lot of contrarians that the market likes to climb a wall of worry. The market has climbed a increasingly strong wall of worry over the last couple of months. Do you have a question? Yes, sir.
Is it possible that it's not as bullish as we think it is because the traditional metrics for measuring bullishness are not really in play or have not actually been developed, or it's not communicated to us in commonality that the average person would be able to know?
Well, that's a great question. I mean, and no one really knows if, insofar as there are new metrics out there that we've never discovered yet. In terms of traditional metrics of bullishness, I assume various levels of fundamental analysis you would be referring to. What we have found, as a general rule, is that though those measures have more ability to predict the market's, general direction over longer periods of time, they have basically no ability to forecast the market's near-term movement. And this is nothing original, but basically, fundamental analysis is, insofar as it has any ability, is over the longer term. But you remember Schiller said the market was irrationally exuberant in '96, and the market then crashed after the internet bubble burst in 2000. Was he right or was he wrong? Well, from a market timing point of view, the market nearly doubled during the time you were waiting for him to be right. I think what you're asking is, are there measures of fundamentals of the market that are different than before? There could be, but what I would say is, even if there are, they have never been all that helpful anyway in predicting the shorter term. Basically, relative to the long-term fundamentals, people can get too excited or too pessimistic. And what contrarian analysis does is focus on those levels of extreme, irrespective of what the long-term trend of the market is. So the market might be awful, but is it as awful or is it better than what we think it is? And that's what contrarian analysis looks at. And I've tried to measure the extent to which these sentiment indices I create have any predictive power. And it's a very, very short term. We're talking, at one point it was as many as 3 months, so that's even coming down. It's close to about 1 month right now that it has its greatest predictive power. So we're talking very short term here, whereas fundamentals are much more long term. Yeah?
So what exactly do the percentages mean? What do the percentages of this index mean? Does it 40% mean that for domestic equity market timers, they have an effective 40% long exposure?
Yes.
And negative? Okay.
So these, by the way, just to answer your question, I'm looking at market timers that are in a binary world. So it's either cash or equities. And in equities, they could be short too. So that's why you could go down, and you have negative numbers, mean that are on average short the market. So they may not, from a financial planning point of view, have much in equities to begin with. But relative to whatever amount they have in equities, are you fully weight or you don't have any of it in there? So.
Hello. To what extent does retirement money, like 401k and so on, impact market performance? Because it seems to me that money continues to flow into the market regardless of how it's doing and stay there.
Well, great questions. A couple things. Insofar as something is known to happen in advance, it's already reflected in stock prices, I'd say. So the fact that 401ks keep investing in the money is not a surprise. So that shouldn't affect the market's near-term movement. So that's one thing to point out. But secondly, I'm not entirely sure I agree with you. There's a lot of flow in and out of equity funds. And indeed, one sentiment measure that I think has a lot of promise, it's compiled by TrimTabs, which is based out here on the West Coast. But basically, what TrimTabs does is look on a weekly basis the flows in and out of ETFs and mutual funds, both equity as well as domestic bond. And those statistics themselves have very interesting contrarian properties. So one of the indicators they look at the most is among these very short-term leveraged ETFs. That you'll see the ones that the ultra longs or the ultra shorts, and usually the market goes the opposite of what the flow is in and out of those funds.
To follow up, it seems to me that if, say, those retirement accounts are controlled by individuals rather than professional money managers, would that make a difference in terms of volatility?
I'm not sure I understand the question. So we should be focusing more on individual investors? Is that what you're saying?
No. Is there any difference?
Oh, you know what? I don't know is the answer to the question. I mean, in newsletters tend to be focused on the more retail investor, individual investor. And so that's what I've looked at here. There have been people who track more institutional advisor sentiment, but it doesn't change as often, so it doesn't have as interesting of short-term significance. But not to say it doesn't have some other properties that are worth focusing on. Okay, so let's look at the next one. This is now among NASDAQ timers. There are fewer NASDAQ timers. I think there's only a couple, 2-3 dozen NASDAQ timers. These are timers that specifically recommend an exposure to the NASDAQ market. So it's going to be a more volatile index to begin with. And secondly, I found that NASDAQ timers tend to be more trigger happy than those who focus on the domestic market as a whole. So you can see the swings are pretty wide here. So back there at the early part of last year, during that correction, we saw a plunge from over 80% to negative 50% in a space of a couple weeks. That's overwhelming. I would never, by the way, suggest that anyone move that much of their exposure level from long to short in a couple week period. But from the point of view of sentiment index, it's actually very helpful to focus on advisors that are that volatile because it reflects changes in the underlying mood. One of the things, by the way, since I'm focusing on it, where contrarian analysis was very helpful, and you can go back and look at my columns on the website, MarketWatch website, is notice that as the market started going down in the early part of last year, NASDAQ sentiment remained at extremely high levels. And it was as though the timers had gone out on a cliff, the cartoon of where you go on the cliff and then you act like by beating your legs you're going to avoid the inevitable, and then finally they plunge. And it wasn't until they plunged that there was the plunge is right there, that the really attractive time to get in the market would emerge. Until that time, there was a sort of a underlying resistance to believing that the market was in bad shape. But look at these plunges in April, and then especially right after Brexit, and then right after Trump's election. And each one of them turned out to be times when the market took off. And again, right now we're seeing something similar to what we saw in the domestic equity market, is that there's not really any level of exuberance among the NASDAQ timers that you'd expect if this were a market top. So even though the NASDAQ composite is close to a high, the average exposure level among the NASDAQ timers we track is almost similar to where it is in the domestic equity market, which is slightly below 40%. So that doesn't mean you should go out and buy the market. I'm just saying that insofar as you were worried that short-term market timers were too exuberant, I'd say that's not something to worry about. Plenty of other things to worry about, but not that. Now, it's interesting. It's a great question. See, my feeling is no matter what factor you bring up, whether it's interest rates or earnings or you name it, or elections of presidents, it's that it means less what happened in any objective sense. What matters is how we react to it. So there are times when the Fed has increased interest rates and people run to the exits and say that's time to get out of the stocks, and other times in which they don't react at all. I think that's revealing, and the former of those two is a more bullish response because they're saying the world's going to come to an end, and rarely does the world come to an end. And so that's, if you were going to choose between those two as to when to step up to the plate, you'd pick the former. So I'm not saying that interest rates don't have huge impact over the longer term. I'm just saying that over the shorter term, it matters less what's happening to interest rates, and what matters more is how we react to what's happening to interest rates. And that sort of accords with Finance 101. It's that markets are, you beat the market by having betting on where their expectations are wrong. So in order for a company to do well, it isn't just to be profitable, it has to be more profitable than it was expected to have been. So it's relative to expectation. Yeah. Up there in the back. How do I measure? Right. I measure exposure. It is, again, it's shameless how easy my job is. These newsletter tells me what their exposure level is. So I monitor them on a daily basis. And so one guy might say, my exposure level is 84% equities. And so 84 goes into the average. Another one might say, you know what, I'm 50% short right now because I think the market's going to go down. So I put negative 50 into the average. So that's all I do. So, yeah.
I would imagine you must have done correlations on various factors that predict sentiment analysis. In other words, what are the prime movers of sentiment analysis, which may in fact be the prime movers of market changes, if this is all causal in any respect.
Right. Well, so what I understand you're saying, it's another great question, is that sentiment reacts to some things. If the market goes up, you typically expect people to get more bullish and bearish. So one of the things that is a direction that I'm going in my research but hasn't really manifested itself in any particular index yet is you can predict what you think sentiment should be at relative to how volatile the market is, the rate of change in the market, that sort of thing. So every given day, you pick whatever model has worked in the past to predict what you think the sentiment index will be today. So let's say that given that the market has been incredibly strong over the last 3 months, you'd predict, I'm just going to make this up, let's say you predict it should be at 60% today. The fact that it's at negative, it's less than that, it's at 39, that difference, that delta between the expected level and the actual level, may be the better sentiment measure to focus on. And I think, preliminarily, it makes a lot of sense. Right now, I'm doing it just sort of eyeballing it back of the envelope, which isn't very rigorous at all. But basically, when saying, here's the market going up and we have sentiment going down, that's the same impulse, it just doesn't have the rigor behind it. By the way, this notion of predicting what you'd think the level would be and then looking at the difference between where it actually is, it's not original with me, but there's some very interesting work done in the sentiment area. It's one of those where a lot of people on Wall Street are focusing on, a lot of academic research is focusing on it. But the VIX, they've applied it to VIX. The VIX itself, contrary to what a lot of people have, has no predictive power whatsoever as a contrary indicator. But if you look at it in this relative basis, where you predict what you think the VIX would be given what the market's done in the past, you look at past volatility, rate of change of the market, that sort of thing. Then look at the delta between that and the actual, has some very interesting characteristics.
How do we follow the user sentiment index? Follow it or go against it?
Oh, great question. I think, what the contrarian would say is that when you get high levels of this index, then that's a case of where you would be cautious about the market. And if it's at very low, you would be more optimistic. So you would do the opposite of what the index would tell you to do.
You are a longtime hero of mine, and I have been a follower of yours and a subscriber for years. And so I was shocked when the letter closed. And I am very interested in your presentation, and have heard a couple of them before on this subject. And given all of the factors that you have been following, I'm really interested in how you guide your own investments. Would you be willing to say anything about that?
Oh, sure. And thank you for being a long-term follower. Where I have most of my money is in index funds. A gentleman was talking to me over the break. It's a fairly standard allocation. I think 85% of it's in equity index funds and 15% in relatively short or intermediate term bonds. And the equity portion is divided, I think, more or less equal between domestic and international.
Can you also speak a little bit about how you've been sort of a guiding light for me for many years, how you intend to continue to interface with the public?
Well, I continue to write columns for MarketWatch, and so just so you know where my columns appear, 3 times a week in MarketWatch, then write periodically for the Journal and Barron's, also USA Today, and now TheStreet.com. So basically, since Dow Jones shut the newsletter down, I've been focusing more of my attention on columns. Now, just so you know, I'm continuing to track monitor the newsletters for the sentiment point of view. I just am not tracking all of their performances.
Well, you may be tracking it, but you're not publishing it.
Correct. Yeah, no. So basically, we had to change our business model to continue to track any of them. We track about 20 advisors on an ongoing basis, and there we offer our auditing services to them. We will continue to audit their returns using the same methodology we did before, but we have a flat fee that we charge for that service. And we then publish our ratings for free, and it's on our website, which is the website that you'll see on the handout at the bottom of the sheet. It's hulbertratings.com, and you can go there and get the ratings without having to pay anything.
So that is some degree of performance rating?
Well, no, it is. It's a smaller sample than what I
Smaller sample of performance ratings, but the performance ratings persist in that form.
They persist, and it's interesting. It'll be an ongoing test of some of the things we talked about earlier, because as you can imagine, the newsletters that have continued to pay us to track their performance are the ones that have had the best performance, right? So
this is a self-selecting sample, but in our favor.
Well, that's a very interesting question. So as of February last year, which is when Dow Jones shut my newsletter down, we know who was the top performer as of February. So that's when they said, okay, well, we'd like you to continue to track our service. So we get to see how many of them are top performers since then.
Would you be willing to say anything about the shutdown of that? Because as I say, I was shocked.
My mother told me not to say anything about anybody unless it was nice. So. No, in all fairness, Dow Jones is not in the newsletter business. They never wanted to be in the newsletter business. They wanted MarketWatch, which was my publisher starting in 2002, and they didn't even, when they bought MarketWatch, they didn't know who the Hulbert Financial Advisors was, and they said, well, what's this property you have over on the side? So they never really were interested in it, and that's perfectly their right.
I would say it's remarkable that at hulbertratings.com, you're still publishing 15, 20, 30-year performance records of dozens of investment advisors for free, and people can just go to the site and see it for free. Is that going to continue indefinitely?
As long as the advisors continue to pay us to track their performance. The humbling thing is after Dow Jones shut it down, I thought there would be plenty of other publishers that would want us to continue using the publishing model that we had then. And I can tell you the publishing world is not a good industry right now. It's and there was zero interest in having me continue to track, which is a fairly expensive operation because we have to not only have a staff of analysts, but get data feeds and a lot of computing power and that sort of thing to do all those calculations. And so, I'm not crazy about the business model that we came up with because it's sort of like a Standard & Poor's or Moody's, and we saw the problems that led to prior to the ratings of the subprime mortgages and so forth prior to the financial crisis. Now, I don't have any doubts about my objectivity about it, but it's not a sustainable model going into the future. But for now, it's going to continue. Yeah.
Do you use ETF indexes or mutual fund index funds?
In my portfolio?
Mm-hmm.
The 401k that I have is a legacy of Dow Jones World, and they did not have ETFs in it.
Okay.
But again, I was talking to a gentleman over the break about this. I don't see a huge difference between ETFs and index funds in a tax-deferred environment. So, and they're both similarly low fees. I mean, like in Vanguard's case, they're the exact same fund, just a different share class.
Well, it's just that my holdings are with Fidelity, and if I want to buy a Vanguard mutual fund, there's a big fee associated with that.
Yeah, though, you know, it's interesting. Fidelity right now, just you saw it, I assume you saw it in February. They actively are now competing with Vanguard as to be the low-cost provider. So, I mean, we're all winners in that game, by the way. I mean, you know, I don't care whether Fidelity or Vanguard gets bragging rights about that. But, you know, Schwab now is down. You can get the total index fund at Schwab for 3 basis points a year. Isn't that incredible? And it's just mind-boggling. You know, it's interesting. I go off on a tangent here. A lot of the back studies on things like the 39-week moving average or any of those strategies where you'd get in and out of the market, you know, any back testing before 1990 or so, maybe 1980, but 1990, so when it became relatively cheap to do that, is suspect. Because you imagine they go back in 1929 and say, well, if you got out of the market when the Dow went below its 39-week moving average, do you imagine what it took to get out of the market? You know, you'd have to sell all 30 stocks and pay a fixed rate brokerage commission to get out of those stocks. It wasn't just one ETF that you could get out of. And so you include any realistic commission rate and the amount of effort it would have taken to get it out of that fund in 1929 is just not at all comparable to the last 20, 30 years. Yeah. These are ETFs? Well, I should never speak beyond my knowledge base, but that never stopped me before. So I think that any fund of funds is suspect because it's just a layer of fees on top of it. Right. Yeah, I shouldn't speak too much beyond it. But anyway, let's just say I'm suspect. So, okay, yes, sir.
A decrease in the number of overall stocks in the market for people to purchase, and also that we're in a winner-take-all environment where a smaller percentage of companies are taking a larger percentage of the profits. Right. So I'm wondering, in your index funds, do you have a preference for like smaller cap indexes or larger cap indexes, given the environment that there's kind of this consolidation in the market toward, sounds like larger cap companies?
Yeah, my index fund is the total market, so I'm not taking a tilt for or against small cap or large cap. There are plenty of people who argue on both sides of that question, and I'm not taking a bet on it. It used to be that it seemed like a no-brainer that you go into small caps, but in fact, the small cap effect has been more or less non-existent for 20 years. So, there are a number of theories as to why that is, but one of them is this winner-take-all economy that we presumably are moving in, where many more small-cap stocks are going to not ever show any profit. Yeah.
I would just, to get back to the chart for a minute, make the point that the so-called market timers are really market followers in many of the instances as shown in the chart above. And they're basically paid to predict the market. On that basis, I'm not so sure that it would be all worth that much money to get that kind of information.
Yeah, no, you're absolutely right. I mean, the reason a contrarian would focus on it is because of exactly the phenomenon you're talking about. Everyone likes to think they're different, but in fact, they're market followers. Human nature being what it is, and this is back to a general point about contrarian analysis, we all become more optimistic when things are going up, and we become more pessimistic when things are going down. That's human nature, and despite all appearances to the contrary, market timers are human beings, right? So they become more optimistic as the market goes up. So you don't necessarily, you could fault them for that if you were paying their subscription rate. But from the point of view of a contrarian, they're gold, because you want to not do exactly what they're doing because they're doing it the way we shouldn't be doing it. So, yeah. Sure.
I have a question and a comment, and they piggyback on each other. The comment is just my personal opinion. You named two kinds of events. You say a few slides ago you asked people, would you buy after Trump was elected? Would you buy after Brexit? Yeah. Personally, I would, because I thought, and I still think, events like that are very predictable, kind of fear-based. That's human psychology, and it's not something fundamental in the market. But would I have bought after the 2002 drop? I don't know. Then I'd be fear-based. And so my question, piggybacking on that, is what is the argument for the general overall fundamental argument for following a contrarian approach? Because back before the break, and we were arguing, you're not alone. I mean, many people argue that there's no way to know what's going to happen in the future. All knowledge is already incorporated into the market and into market prices, and nobody can foresee the future. So we can look at AAII contrarian sentiment, but what do those people know that we don't know? Where is the knowledge coming from that supports a contrarian approach?
Right. That's a great question. See, I don't think they know anything more than we do. I think what we're banking on is that they're reacting emotionally, or at least some of them are, and they're overreacting. So it's basically an overreaction thesis. So that when people get fearful, they get too scared. And when they get greedy, they get too greedy. And so it's not to say that things aren't bad or good in any given time. You're betting they're not as bad or as good as what the sentiment is. So you're not basically having to presuppose any extra knowledge on the basis of anybody. In fact, it presupposes they don't, but it presupposes that they tend to overreact. Yeah. So, by the way, I want to draw your attention. There's in your handout that, this is an article that Brian Livingston wrote, and Brian is up here in the back. So I thank him for this. He took the general stock market sentiment indicator and looked at how the market did when there has been an extreme. If you look at the top of the second page, I should get Brian down here to explain it. I'm explaining his graphs. But if you look at the top of the third page where it says excess optimism precedes poor 1 week Dow return. So you can see that when there's excessive optimism, that's as indeed a contrarian would predict, the market tends to do particularly poorly. If you go over to the left-hand bar, you can see after extreme low readings, the market has done relatively well, though interestingly it also did when it's in the middle of the pack too. So a couple of things to draw from that is that you could say excess optimism is more something to be afraid of than excess pessimism, or another way of drawing a conclusion from that is contrarian analysis is no panacea, which I would want to say as a true about this before we have any discussion about it. But Brian, do you want to say anything more about that?
I just introduced myself. I'm the president of the AAII chapter in Seattle. I just wanted to contribute a little bit of analysis to what Mark has done. I would say I fully expect the brains of Silicon Valley to extend this analysis and help us find a lot more about it. There's a tremendous amount of data. Mark has gone back to the year 2000 and even before that to find the sentiments of these analysts, and the fact that they're wrong so often of the time is really a remarkable comment on human nature. We all guess wrong when we're presented with financial data. It's just a fact of life.
Yeah.
The question has to do with active money management versus passive money management. It's intriguing to me that knowing the fact that about 85% of the active money managers underperform the market over the time. And if we're looking for one of those 15 that outperform the market, it's very likely that those are not going to be the ones that are going to be outperforming in the next year or 3 or 5 years. So how come most of the people in this country and in the world are still pursuing the active management when the facts are saying that it's failing heavily? Even institutions are moving out of hedge funds and active management and are going index. How do you see it?
Well, this is where I should have my wife come do the workshop, because I think it gets into human nature. And hope springs eternal, doesn't it? I mean, why are people sitting at slot machines in a casino? It doesn't look like they have any shortage of people willing to put huge amounts of money on it. And there's no doubt that that's a losing proposition, but yet they are still motivated. Why do people put money on any lotteries, state-sponsored lotteries and that sort of thing? Again, it's an irrational thing, and yet people do it. And so, I can't say anything that we don't already know here. I mean, but just human nature is such that we like a challenge and we think we can do better. And so, and we are motivated by that, slim possibility that we're going to make it rich. And so we keep going.
Quick follow-up. How do you do to receive all those newsletters? I mean, you really scrutinize these guys and in many cases criticize them and tell the truth. How do they send you the letters, or do you have to pay for 200 letters, or how does it work?
Well, no, it's interesting. Though I've been critical of newsletter editors of my career, I will say, and this sort of looks like a compliment, though it's really a backhanded insult, but they're remarkable personalities, is a general rule. And they believe in themselves. And so I remember this is back in 1982, and it's an editor who has long since passed away, so I can tell the story, but I'm not going to give the identity. But I had, his performance was terrible. And CBS News was doing a piece for their nightly news. And, this is not a good example of objective journalism, but CBS wanted to do a hatchet job on newsletter editor. And doom and gloomers. They wanted to do these doom and gloomers. We shouldn't pay attention to them. And so they were looking for anything that they could use to lambast the doom and gloomers. And somebody said, they ought to go talk to Mark Hulbert. So they came and interviewed. So I immediately get a call from the agent of this particular advisor, who knew that we were going to, both the advisor and myself, were going to be at a conference in a couple weeks. And he said, so-and-so would like to meet with you. So anyway, so I did. I went. He was very gracious, offered me a cup of coffee, and we sat and chatted about his grandkids and all this and that. Very nice, right? Well, he had to go. I got up and left. That was it. We never once talked about my performance methodology, no nothing. And subsequently, I think there was a follow-up from CBS News, and they came and interviewed him. And they said, well, according to Hulbert, your record's awful. And his response, I kid you not, was, oh, that can't be true. I met with him, and I was very nice to him, and he liked me. And I think, yeah, what'd you say? Yeah. Did everyone hear that? Yeah, so, anyway, yeah. So I do think that there's hope springs eternal. And so why do these people continue to send it to me? I mean, I have to subscribe in some cases. Sometimes they're happy to send it to me. I mean, I often will write about their points of view in a column, and people realize that the worst publicity is none at all. So as long as I spell their names right, so they'll do it that way. I mean, Joe Granville, remember Joe? I mean, his performance was one of the worst of any that I tracked. But he was exceedingly friendly. And no matter what, he would send me his newsletter. And, I think he realized before most that as long as you get your name spelled right, it's, it helps. I was on Wall Street Week. Remember that show years ago? Once. And on one hand was Al Frank, and the other was Joe Granville. And the show was the best and the worst. That was how Rukeyser did it. And I don't even remember Al Frank, but Al was not the most videogenic of people. And he was sort of bumbling and, roly-poly St. Bernard, as one person sort of likened him to. And he, Rukeyser asked him what stocks he liked. He says, well, I get stage fright. So he had to pull out a piece of paper and say, he did not look like the kind of guy you'd want to manage your money. And then you have Joe Granville, who's the showman and so forth. I'm convinced Joe Granville got more subscribers from that show than Al Frank, even though there's just no comparison to the long-term tracker. So, anyway. Let me quickly go over a couple other, I want to tell you about gold and next. So in the gold market, gold's actually had a fairly interesting run since the election. It's been gone from about $11.50 to a little over $12.50 an ounce. But the sentiment has also shot up fairly quickly. So if I were to look at that, even though the current exposure level, which is right around 20 percentage points over here, is not all that excessive exposure level. Back to this question about looking at it on a relative basis, I'd say, given that I'd otherwise expect the gold market the sentiment to be different, I don't think that's a very optimistic conclusion to draw. So I don't think sentiment, another way of putting that is, I'm not being very articulate here, gold market sentiment does not support a huge run in gold right now. That isn't to say gold couldn't do it, but it doesn't support it. The biggest sustainable moves in the gold market over the last, well, first of all, this is 2.25 years, but it goes back, have been when gold has been down below negative 30 percentage points. And we did get that right before right around the period of election. And we didn't get quite there earlier this year. And yet the gold market has been trying to go up since then. So I think it's on a relatively weak sentiment foundation. And then lastly, bonds. This is not against a bond index, it's against interest rates. So the contrarian thesis is that these two work in inverse rather than together. So don't look at them the same way you look at the other charts. And by the way, all these charts are on the I think you all got handouts. These charts, you can look at them more closely. So for example, so if you look at right there, you'll see interest rates were at a high right around the time of election, and gold sentiment was at a low. So in other words, there was a bet that right now there was a lot of bearish sentiment among bond timers, and instead of going up, the bond market has gone down. So it's just, again, the contrarian thesis is supported by these things moving in an inverse direction. Right now, the average sentiment among the advisors we track is right around the zero mark. It was 1.9% was the average exposure level as of last night's close. So again, I'd say that I don't know how to put an easy tagline on it. I'd say there's hard to draw a very robust conclusion one way or the other about it. It's one of those middle grounds. It's neither bullish nor bearish about bonds. And again, insofar as one were to pay any attention to this, and this is only for very short-term people anyway, most of the time you're not going to draw a robust conclusion, which is frustrating. I think somebody was asking earlier that if you had a subscription service and most of the time you had nothing to say, it would not be in business very long. Well, most of the time, contrarian analysis doesn't tell you a lot. But there are these times when there is excessive bullishness or excessive bearishness, and that's when you would want to pay attention. Yes, sir.
About the predicting versus lagging the markets. Have you slid these on one of these graphs, the two curves, and calculated the cross correlation to assess that leading or lagging?
Well, yes, and I'm sure there's a lot more work to do. But basically, sentiment, I think somebody else was asking this earlier, sentiment responds to what the market has done. So the highest correlations you ever see in this business are between what's happened in the past, and there's a lot that... So basically, we become more bullish as the market goes up and bearish as it goes down. And other things being equal, if the market goes up with less volatility, we tend to see more bullishness than if it goes up with lots of volatility, which is another way of saying nothing that's earth-shattering, which is that we like things go up without a lot of volatility. So if that's all you put in a model and said, okay, I expect, given the volatility in the market's rate of return, that sentiment would be at X level, and then look to see whether we're above or below that, you'd do very well indeed. And that's what I try to do here. I mean, you see what the markets have done, and then say, what would you otherwise have expected the level of sentiment to be? So, for example, look at the stock market. Right now, I mean, the market's had an incredible 6-month run. I don't think anyone would have expected a 6-month run if you'd had a conversation 6 months ago about it, much less if you had been told that Donald Trump was winning the election. And yet here we are. So you'd say, okay, we've had an incredible 6-month run. What would you expect? You'd expect sentiment. If we'd had this conversation on November 8th, we would all have said sentiment would have been incredibly bullish right now. And right now, it's very much middle of the road. So that doesn't mean the market will keep going, but it doesn't mean that sentiment analysis or contrarian analysis is saying this is one of those danger zones of excessive bullishness. So that's the way that, from an anecdotal way, you would respond. I can't see out here.
Given your knowledge base and your long-term experience, do you think it would be worthwhile to write a book like Swedroe or any one of the number of other gurus who've tried to help us?
No.
I was afraid you were going to say that.
No, I really appreciate the sentiment which I feel behind that question. But I'm really, it's an interesting question. I'm near the end of my career rather than the beginning. And I am very humbled by everything that we need to know, we already know. So, maybe this is giving business to my wife, or to her profession, but our struggle...
Well, she's going to write the book for us.
Okay, well, there you go. But you see, I think it's not that we don't need to know anything more than we know, right? Everything I've said today, we know, right? What we need to know is how do we actually put that into practice?
Yes, that's what I was trying to get to.
Right. Well, and I'm not sure I have insights into that. I mean, I have insights into the statistical part of it, but how do we actually put that into practice in our lives? Those are difficult questions that, a lot of people have given a lot of thought to, but I don't know that I have particular insight other than to say, come up with a set of trading rules and actually follow them. Yeah, in the back.
I'm just curious regarding these sentiment indicators. How do you feel about short interest percentage as a contrarian indicator?
I have looked at short interest, and somebody over the break was asking me about the put-call ratio as well. Both of those, at least in my the econometric tests I've applied them to, have not shown particular ability. And I think the reason for that is that given the amount of hedging activities and so forth that are out there, that those statistics are, they're being diluted because there are a lot of people who are, buying puts, let's say, or shorting a stock out of a hedge as opposed to a bet about the direction of the stock or the market as a whole. So I don't know that it tells you what it used to tell you, if it ever did. But at least over the span of time I've looked at short interest and the put-call ratio, it's not a particularly worthwhile indicator. So insofar as, I'm hoping that there's some sentiment indicators that work, but insofar as ones that don't work, The raw VIX, I don't think helps. I think the put-call ratio doesn't, and I don't think the short interest does. Oh, yes.
A couple months ago, we had a talk about dual momentum. Do you have an opinion about that?
I have no idea. What is dual momentum?
So that's the speaker was Gary Antonacci. He's written a book on dual momentum. It's basically you have absolute momentum as a timer. Okay, it's a 12-month game. If you're above cash, you're in the market. If you're below cash, you're out. And then he takes something like the SPY versus EFA to be and does a 12-month momentum gain between the two of them to say should you be in U.S. stocks versus global stocks. And he claims, and he's written a nice book. He's got a lot of awards for this book, etc. That overall it does quite well, and it avoids bear markets. He's done good timing, etc., etc.
Well, I don't know what to say since I don't know about it in particular. But there are a couple things to say. When I've studied moving average strategies going back as long as I have data, so you take the Dow or the S&P back to 1928 or 1898 or whatever period you find, it turns out that if you were to trade in and out of the market according to the moving average, you go through extremely long periods of lagging the market. So, for example, I looked at the 39-week or the 200-day, more or less, equivalent moving averages, and I looked at how many decades you would have not beaten the market by following it, even though over the last 80 years it's beaten the market. So if you were just to look at the 80-year statistic, you'd say that's not a bad strategy to follow. But if you were to look at the number of decades along the way in which it didn't beat the market, it was, I think, about half the decades. So just be aware that moving average strategies, when they work, I guess there are some spectacular times when they work, but there are long periods of time in which they don't work. And this is back to that slide where I showed the percentage of time following a winning strategy can nevertheless be lagging the market. My experience, and this is always one of the worries with strategies, even ones that work, like buy and hold works better than 95% of the strategies, but most people don't have the discipline to do it because it takes too much discipline to do it, especially in a bear market. And there's a similar degree of discipline on moving average strategies. So that's one thing. I also point out, one of the newsletters that used to have the best track record, and still has a decent track record, but not as good as it used to, is one that follows momentum. And it's the No Load Fund X. I don't really know this service. But it ended up losing almost as much money as the market during the 2008 downturn. So their momentum strategy did not help them. Now, you could say, well, there were some ways in which they weren't really putting momentum into practice in the right way. But I don't know. I mean, I think they've done more research on momentum and how to put it into practice than anyone I know. And they were unable in real time to actually help. I always worry that there's back testing that can say if we had done it this way and that way and so forth. By the way, and this is, I don't know how our timing is, but one thing to be aware of, whenever you look at tests, and even ones that on paper look to satisfy a 95% confidence level, you need to look at how many hypotheses were tested in the process of coming up with that one that worked. And you'd expect, if you have 100 strategies, there's going to be 5 false positives, right? You're going to have 5 that came out of just randomness alone. And so you need to adjust your statistics according to how many hypotheses were tested. And it's rare, even in academic work, for people to show how many strategies were tested in the process of coming up with the one that worked. Yeah. Okay. Okay, thanks. Thanks, yeah. Yes, sir.
Quick question. I get asked this a lot. Now that your newsletter is no longer being published, okay, Hulbert Financial Digest.
Right.
Lots of questions about where can we find back issues? Is there an online database? Because you did over the years you did many valuable studies, talked about various newsletters. Is there anywhere that you know of where we can go and get the actual issues that you generated over the years?
Yeah, I mean, Dow Jones continues to own all the back issues because they haven't relinquished that. So I guess I wouldn't even know where to go at Dow Jones because they probably don't know where to get them. They're sitting on some computer there. But I'm afraid that's probably the right answer to give, even if it's not the one you'd like. Yeah. Yeah.
Any more questions?
So this will be our last question. Thank you.
AAII has interest in teaching, helping people. You've been doing the same for, 37 years? I've been receiving your newsletter, subscribing for 30 years. And it's very commendable effort. How come we see that investing is not taught to the kids in the schools, high schools, college, and even if you go to an MBA in finance, they don't teach you how to manage your little money. They teach you how to manage huge money for a large corporation. And because of that, for my calculation, between 60 and 80% of the profit of the person, and sometimes it could be even more, it depends how long the person is going to live. That profit from 60 to 80 is going to be taken by Wall Street, which is very sad.
Right. Well, no, point very well taken. Who knows all the reasons why that is the case? Wall Street has a vested interest in us not knowing that, right? So, and just look at who funds a lot of the big business schools. So that may tell you all you need to know.
I'll make a quick comment on that from an AAII viewpoint. The HQ people, okay, the chapter, and a guy named Tony Hausner, okay, who's out of the Washington, D.C. Chapter, for the last year has been meeting with a variety of people from the Treasury, the SEC, some industry people, trying to put together some sort of curriculum, okay, about financial education. How do we teach our kids? Okay, because somehow or other, all that got kind of lost. Okay, and so there is an effort going on. The government isn't known for moving lightning fast. Okay, so it's going to take a little while, but there is some efforts going on.
That's it, I think. Thank you so much for spending your Saturday morning with us.